So at any time, we use this, it's called an AIM, our trading platform here. We have 5 that we can set it up to.
So you're sending to 5?
Yes,
Brokers
we're saying we
saying-
want to buy $20 million of this T-bill
Right.
from you. And as when we hit submit, they send back their levels to us. And what's nice is that Bloomberg has it a bright green, whatever the best rate is. When we, so Don will show you, we'll submit it.
All right, this can go quick.
Yep. And then the bright green one, that's the best rate. That's the best price. So that's the one we're going to pick in this instance at that a yield of 2.413, which is exactly what we saw on the first screen. So good level. But all the brokers get an idea of if they were accepted or covered trade.
No, wait a minute. So accepted, that means we accepted it.
Yep, and the
What does
broker
traded
dealer
away,
accepted.
what does traded away mean?
So those broker dealers get a message that they did not win.
Oh, okay.
So this, the second best one covered, and they get that message, they were the cover.
Yeah, so they were close.
And then the other ones, you weren't covered, it traded away from you.
Yeah.
You were covered. Means
So
you
it
were
was,
close?
yeah.
You were second, but you were second best is covered.
Yeah. And John gives a lot of covers in our other system.
So do they use that information that traded away or covered to make changes to the
Yeah.
rate
Yes,
for the
they-
next time?
Well, we assume that they do.
Right, yeah,
But yeah, they,
Interesting.
Yeah.
well, we're a little wide at the market.
right, yeah, yeah. And then, once we're done with this, we would find Tim and ask him to approve this trade that we did.
Now, do we know that they've said, yes, we'll
Yep,
take
they
this?
get a message immediately that they are done on that trade.
They're done.
Yes. And then I would also send the ticket to Kelsey in accounting to book for me, and that is how we trade T-bills and stuff. The takeaway from this short presentation here is that, yes, there's a lot of money in SIP, and there are a lot of trades, but we do have tools such as Bloomberg to do it efficiently. Are there any questions? Would you like to see any other Bloomberg screens?
My question has to do with your book.
Oh, yeah,
I'm a little surprised that it's
a paper book.
Yeah. So do you do anything electronically that just says to your team, just bought this on this day, or is the book just
So
right
the
there for all?
BDS screen also shows all the maturities as well. The book is kind of a legacy leftover. I thought about trying to make it more electronic, but it's nice if I'm gone, there's a big red book on my desk that John can grab and see what days need to be
So
filled.
it's kind of like one more check to make sure that you're filling in all the blanks.
Yes, yes.
So the maturities we can get here, but what we can't get in a very efficient electronic format is expected expenditures.
Right.
You know, 100 million going out for OPI or something.
Right, and that's why I was thinking maybe there was some electronic calendar that you were sharing, but the paper thing surprised me.
Yeah.
So that's the only piece of paper we have left from as Kirsten mentioned, the real volume several years ago.
Right.
I have a question for Director Bill. So given that there are pretty predictable payouts, let's just say with OPI, for example, could we automate that information and make it more available? At
With-
least for those predictable.
With OPI, it is more predictable than it was a few years ago. We put in a double check when cash got tight so that the Board of Public Ed sets the date that the cash will go out the door. Medicaid, probably not. That's just a user system. Healthcare benefits, probably not. But I think within K-12, yes. Corrections, yes.
Pensions?
Pensions, yes. Payroll, yes. University, yes. DPHHS, no.
So how many times in a month, year, whatever, do you come up to a day and go, oh my goodness,
it happens a few times. Try not to put too much cash, as I said, on one day, because that would be a lot of trades, you know, and I actually start at home in the morning, trading before 6 a.m. most days, just because sometimes you can get a better rate that early.
No, I mean, days where you worry that we don't have enough cash to,
So we hold 100 million-ish in a money market, in 2 of our money market funds, and those have 1 day liquidity.
Oh, okay.
So if I came up on a day and said, oh, there's $70 million I didn't know had to go out, I would sell the money market.
oh, okay.
Yeah, and so that's same day liquidity. You can sell it in the morning and it's there in a matter of, well, it's to our custodian in a matter of minutes.
Oh, okay.
Yeah,
So that's the backup to.
yeah, right. And then, you know, treasuries we can sell if necessary as well. Using the same thing we did this morning.
All right.
What's the backup, I'm sorry,
Well, yeah.
what's the backup to 2 or 3 of you?
Well, that gets difficult. That's the bad burrito scenario. We never all eat the same burrito. So there,
And that's it? That's the plan?
That's our continuity of
That's our
operations.
plan.
I'll put that in a minute. Joe can do trades. Furthermore, we do have an additional backup, and that is that we maintain 50 million in T-bills that is custodied at US Bank. And so that could be a call to US Bank and say, sell all of the
That's the
T-bills.
depository bank,
Correct.
as opposed to the
Custodial.
custodial bank?
Right.
Okay.
And so then that money would then show up in the bank account without having to go through the custody bank in a matter of minutes. And again, we worry about not having enough, not necessarily on a day-to-day having too much.
It's okay to have some left over, it's not okay not to have enough.
Right.
Grain in the bin, so to speak.
Yeah.
Okay, anything else? Anything else, guys?
That is everything, Chris.
Thank you so much. And we are scheduled for a break until 11, so right on time. Or 10. 10.
Very subtle ask for a.
Oh, no, we're not. I'm sorry.
Nope.
We're not scheduled for a break. I'm
Although
sorry.
it'd be difficult to follow.
Yes.
Do you want to?
Take a break.
Want to take a break before we get into our quarterly? Okay, let's back online. No, she's here. All right. Quarterly performance report.
Thank you. If it's okay with you, Mr. Chair, we'll start with a few topical comments about the capital markets, since they've been in flux here for the last 5 months in particular. And then we'll go into a little discussion about what we've learned about the behavior of the portfolio that should be, in our opinion, of interest to the board, given its responsibility for monitoring the performance and understanding it. So with that, I'll turn it over to my colleague now.
Mr. Board members, it's a pleasure to be here. It's great to see everybody. We have in the materials, as you've seen, we have a lot of market commentary. Obviously, fourth quarter was pretty interesting. I'm not going to delve into it. What I'm going to do, as Jim suggested, is we're going to kind of stay with, I'm going to kind of focus on what we see are kind of the 3 themes that played out over the last 6 to 9 months. And we're we're going to focus on those in the context of, we anticipate that those themes are likely going to continue probably over the next year. They were big drivers of performance, and so we think it's appropriate to kind of stay with them and see how it plays out. I'm going to cover the three themes that we think are the big ones. The first one is kind of the market performance in the context of policy. Monetary policy has obviously been a big issue for years. It was a big issue last year, and thinking through expectations and also their reactions. We're going to then kind of shift gears a little bit into treasury yields, and in particular kind of an inversion risk that has been playing out. We think that there's still a risk. We're going to talk just briefly about that. And then lastly, which also relates to kind of the yield inversion and also policy, is just the broad deterioration in global economics, primarily focused on overseas, but there is some US-related deterioration that we have been seeing. So first, let's just focus on the policy piece. Obviously, why this matters, policy was a very big driver of markets last year.
And Mike comes from the Fed, so when he says policy, he means monetary.
Monetary policy, sorry, yes, my bad. So, level set just real quickly. We started 2008 with a fiscal stimulus package that was a bit unclear. We started the year with, solid employment, decent inflation expectations. So when we started the year off, the FOMC was expecting about 4 rate hikes. So that was what their message was. The markets saw something a little bit less. They were saying maybe 2 to 3. So immediately we had kind of a bit of a disconnect. That's not atypical. That does happen where policymakers will think one thing and the market's a little bit different and more price oriented. So we started off like that. As the year progressed and we got better clarity on the fiscal stimulus, and we got a better sense of where it was going to go and how it was going to be spent, as that started to solidify, we also started to see deterioration in overseas fundamentals. Mainly Euro area, but also some additional, other countries that were starting to deteriorate. That started to impact markets. Right about, kind of midway through, things really started to accelerate, and what the market was anticipating was that the Fed was going to be better at acknowledging that, and they didn't. And what that created was an even wider difference in expectations. The Fed was staying with their idea that they were going to do 4 rate hikes, and as we headed into the third quarter, we started to see kind of breaks also in domestic markets, namely inflation expectations. Inflation expectations are a big piece that policymakers look at when they're thinking about the future of monetary policy. Okay? In fact, if you go back and you look at prior quantitative easing programs, one of the big catalysts was a deterioration in inflation expectations, driving them to do another program, which is why we had basically 4 quantitative easing programs over the time. That started to impact markets. At the same time, Chairman Powell came out and said in a speech that was kind of right around the beginning of October, said we are a long way from, or not, it's a bit of a stretch, we're a distance away from neutral. What that was signaling was we anticipate going through with our rate hikes, and we also anticipate the rate hikes that we're thinking in 2019 and 2020. The market was not a big fan of this and started to price accordingly. Markets started to deteriorate further. A month later, Chairman Powell did try to talk that back a bit and try to ease a little bit of the market's nervousness, but in fact it actually made it more confusing because the market's response was, a month ago you told us we had a distance to go, now you're telling us we're very close. The data doesn't reconcile between those two, so it actually created a bigger problem. As we headed into the year end, and we saw December really start to fall apart, December policy was priced in and it wasn't going to change. There's a number of reasons why, primarily because it was so priced in that unwinding that would have also been disruptive to markets. So policymakers went through with the rate hike. They tried their best to talk down expectations for 2019, and they've done so into this year. Right now, the expectation from them is 2 hikes. The challenge here is that the market is actually pricing 0, or pretty close to 0, And in fact, a few weeks ago, and maybe even haven't checked lately, they were actually starting to price in a rate cut. Okay, that's a pretty big difference between expectations from the market and the FOMC. So that's a lot of what we saw in December. That's a lot of the price action. A lot of that confusion is what drove such a massive deterioration. Why do we care? First and foremost, like I said, policy is going to be a big thing this year. The Fed has signaled that they're going to pause. They still haven't taken off the 2 hikes yet from the summary of economic projections, the dot plots. We'll get better clarity on that coming into the March meeting. I anticipate that they're probably going to try to talk back up that risk a little bit and kind of get out that risk of a cut, because I don't think they are a big fan of that. And then the second piece of why I think we should care is that if markets actually do turn around, and we do start getting some more inflation risk being built back into the market, you are going to see the expectation for policy come up. That expectation for policy for an increase in rates could very well lead us to a Treasury yield curve inversion, which we're going to talk about, kind of the second theme that I'm going to talk about.
So what you're saying, Mike, is that we may be setting the market may be poorly set up for a Fed that needs some statistical data that comes out and has to actually start talking about additional rate increases.
Yes.
Because the gap that Mike described, and we don't want to focus just on the risk, but part of our job is to look ahead for you, for our clients, and ask the question, what could go wrong and how well is the portfolio positioned? So I'll be talking about
Yes.
that part. So there's a potential expectation gap that might be building out there
Yes.
when people are talking about, gee, the next move could be that the Fed might cut rates.
Right, that's right. Actually, before I go into the yield curves, any comments or questions on policy or anything I should clarify?
When you talked about Chairman Powell not being clear,
Yeah.
is that a function of just how the system works, or is it communication skills, or is that going to be an ongoing problem?
I think the Fed has done a very good job of being more transparent since the crisis in particular. I think Chairman Powell does a very good job of getting the consensus of the committee, maybe more so than prior chairs. But that can also lead to challenges in his communication. Because, what you had with, say, Chairman Bernanke or Chair Yellen was you had economists with deep experience. They knew the words to say, they knew what each word meant, and literally down to the way they structured their sentences, they knew what the message was coming across. I think Chairman Powell is learning how to do that a little more concisely. We will see. There has been this challenge with communication, but other committee members have stepped up to try to focus that message. I think we'll get more of that message heading into March.
But Jack, it's a rock and a hard place position, because on the one hand, he has to preserve the flexibility of the Fed to respond to things that could happen. And so he can't be too concrete, nor can the Fed as a whole. On the other hand, it was really helpful for the Fed, since it's going to have, and has had certainly in the recent decade, such a powerful effect on asset prices, to signal ahead as much as possible where they're headed. Hence what's called the dot plot, where they don't assign names to the expectations where rates are going to go, but each Federal Reserve Board member says, here's where I think rates are going to be, short rates that they control. They can't control long rates. But then the third thing is that he also has to manage, there's a vote. He does not, he has to manage his own internal committee. Oh, and by the way, he has to keep the independence of the Fed from being overly threatened by the Congress, and he's got to fend off the president as well. So to the extent that he does it, he has good communication or bad communication skills, there could be a brilliant speaker in the Federal Reserve chairman seat, and all of those pressures would still come to bear, and it would be difficult. So I hope that's responsive. Your second?
Yes. So the next theme that I think is important to just briefly discuss is the movement in the yield curve, is something that is heavily watched, and it's largely because it has this really pesky way of being a fairly reasonable, solid indication of pending recessions.
Is everybody clear about the yield curve and what it is? We've talked about it a lot, but
So I'll give you a real quick overview. So what we're talking about is the Treasury yield curve, so the securities issued by the U.S. Treasury, right, risk-free securities. And broadly speaking, what drives yields, for Treasury securities in particular, is a combination of inflation expectations, growth expectations, and policy, okay? That is a broad generalization. There's risk in there, here and there, but for all intents and purposes, if you look at it through that lens, it gives you a pretty good handle on expectations, okay? If we take that and we think of it from an economic fundamental standpoint, and we start talking about inversions, the definition of an inversion is simply that you have a longer maturity security with a lower yield or lower interest rate than a shorter dated security. So take a 2-year security at 3% and a 30-year security at 2%. Economically, that doesn't make sense, okay? Taking that much risk for 30 years, only getting 2% is not better than taking 3% for 2 years, broadly speaking. Now, the challenge here is that not all inversions are the same. So securities at various points across the yield curve give you a better handle on expectations for policy or for inflation or for growth, right? So said another way, do we really care about the difference between the 2-year, or the 2-month and the 3-month? Not really. Okay, they're basically trading about the same, and even if there is an inversion, it's not telling us much. What we're more focused on is the really short-dated 3 months, 6 months, a year, out to the 10-year to the 30-year points, okay? There's been a lot of work done on inversions as a predictor of recessions, and it's pretty solid research. There's been a couple. One that's heavily watched is the difference between the 3-month Treasury bill and the 5-year nominal Treasury security. Okay, the difference between those two in an inversion I'll talk a little bit about the statistics of it. The Fed in particular has done a lot of research. They tend to prefer to look at the 3-month versus the 10-year, okay? So back to kind of why this matters, if you look at some of the research, and in particular the 3-month, 5-year, it's basically batting 1,000. It's predicted 7 out of 7 recessions with essentially no false signals. I mean, that's a pretty good, in my mind.
it's extremely rare in the capital markets to have an event that has so far 100% track record in predicting something in the future.
Right. The Fed, like I said, looks at 3-month, 10-year. It's not as good, but it's pretty darn close. I think it's like 6 out of 7 in their metrics. So, broadly speaking, looking at the yield curve as a means to kind of get a feel for the recessionary risks is a pretty good way to look at it from a simplistic point of view. Obviously, there's different ways to measure it. There's different model components, but they all basically lead to the same point. Right now, currently the 1 to 2 year point is inverted, the difference between the 1 year and the 2 year security, and the difference between the 1 year and the 5 year security is inverted. So, we're starting to see these signals that there is this tendency. For the studies that I talked about a second ago, the 3-month, 5-year, that's got about 10 basis points to go, and in this environment, that's not a significant amount. For the 3-month, 10-year, it's about 30 basis points. So that's pretty tight. So it's in the process of happening. It's been happening for a while. Do market participants expect it to invert? Broadly speaking, yes. The problem is there's a lot of different ways to think about timing. Some are saying sooner, some are saying later. That's where the battle gets played out.
But in the commentary you see in the capital markets, as Mike said, the reason people are, and there is a boatload of punditry going on about the yield curve inversion, is because it has had a pretty good record. When short rates go higher than long rates, it's been a pretty good signal that somewhere down the road there may be a recession. And so there's a lot of concern about that. And so we're seeing no end of discussion about it in the capital markets community. We're not quite there, but the yield curve has flattened, and at the front end, it actually has inverted, it's kinked a little bit. So that discussion about the yield curve and what it may portend has gotten quite heated over the last couple of months.
On page 22 of our materials, we have a yield curve in the bottom right. The green line is where we were at the end of the year.
Is this the executive
This is
version?
the executive summary, sorry, you're right. Executive summary, page 22. While you're looking that up, I would say that there's probably two factors that I think are probably the top two are pretty close to it about what could actually drive the inversion. First off is policy rates, and in particular, if inflation risk comes back in, like I said earlier, you can expect policymakers to increase interest rates. That's going to bring up that 3-month rate. Like I said, we're only 30 basis points away. Hikes have been roughly, let's call it 25. You know, that's a pretty big move that could result in the inversion. The other component, which is going to lead into the third theme, and that is, and which could drive it. And this is kind of a new theme, which is I think it's important to bring up, and that is we're seeing fundamentals, international fundamentals deteriorate.
Before we go
Yes.
to GDP, before you
Oh,
leave
sure.
the chart that Mike directed your attention to on page 22, look at the lower line. This is what the yield curve looked like, short rates to long rates in the end of 2015. Now look at the green line that starts way up above. As Mike said, what has happened is the Fed has operated at the end of the yield curve where they have substantial influence, which is in short rates, and they have pushed that up. But notice how little change, relatively speaking, has occurred at the long end. So the yield curve has twisted and twisted and twisted, and now it's got, you can see the kink that I was talking about in the green line. It looks like if this were to continue, as Mike said, if there was a bad print on inflation that caused the Fed to hike one more time at the short end, we would get that inversion, and it could very well have effects on equity and fixed income investor behavior that could that would be challenging for your staff and the portfolio to deal with.
One of the additional points to make on that, I think, is that when you look at that 10-year and you look at the different lines, they're all pretty tight, and a lot of that, as I suggested earlier, that maturity point in particular is a pretty good reflection of inflation expectations and growth. And we've all been watching the news, we've all been watching markets. We're not seeing material increases in inflation or inflation expectations. We're not seeing material increases in growth. So that tightness at that 10-year point over the last 5 years is consistent with what we're seeing in the markets.
So you have an inverted yield curve in the 3-month to 5 years. That's 100%, no, if you
sorry.
do, yes, you say that's a 100% correct predictor.
Well, a sample size of only 7, so
Okay.
it doesn't happen
It's a
very often.
small sample size, it's 100% predictor of a recession at some point in the future.
The average.
What's the point in the future? I mean,
The average of the 7 instances is about 18 to 20 months.
so at some point in the relatively soon future.
18 to 24 months in the context of a perpetual fund that's strategically run, yeah, that's not the long run. That's
not
relatively
okay.
soon.
So the other element I'm going to talk about just real briefly is international deterioration, like I said. And in particular, from the yield curve perspective, this is a new thing that we've seen over the last, since the financial crisis, and that is Treasury securities in particular are basically turning into insurance contracts. overseas investors, anytime there is a deterioration in markets or flight to quality flows, which we heard in the previous discussion, overseas demand is going to drive that 10-year, 7-year points, which are kind of the segment where the international investors like to be, foreign central banks, monetary authorities. They're going to drive that yield down. That could actually be what pushes the yield curve to an inversion if we don't get a parallel shift in the yield curve. If 3-month rates kind of stay where they are, we could see that 10-year yield drive down through on.
So the bottom line is that if an inversion occurs, this time it might actually be driven by a much faster deterioration in economic growth, particularly in Europe, but also slowdown in China, in Japan, and so on. It wouldn't necessarily be a full reflection of what was happening in the U.S. economy. And keep in mind, your portfolio is heavily oriented toward the U.S.
And one of the last things that some of us treasury nerds keep an eye on is, in the last round of treasury issuance, demand by overseas investors was notable. Typically you get a little bit of a rise in rates as those auctions occur, but in this case they were solid participation, meaning that they are finding these yields attractive, and they have no problem holding them on their balance sheet, which,
And they're scared of their own.
and they're scared. Lastly, and this will be very brief, and as I had suggested, international growth has been deteriorating. We talked a little bit about the international markets yesterday. This has been happening over 2018. It's accelerated a bit heading into the end of 2018 and beginning of 2019. Euro area measures are slowing in particular. Italy slipped into recession at the end of January based on Q3 and Q4 GDP. The EU was downgraded. EU growth was downgraded to about 1.3. German data has been notably soft. If you look at the German yield curve, it's negative almost out to 10 years. The 10-year Bund is trading at, let's call it 13 basis points, which after 10 years of the markets that we've seen, a 13 basis point yield on 10 years is not what you would hope to see. Japanese yields are negative out to 10 year. That's a pretty notable dynamic. And broadly speaking, consumer sentiment, both Europe, Japan, China, is all starting to turn over and deteriorate.
So as you can tie this back to what your staff said yesterday about the effect of currency on your international equity holdings, to the extent that we start to see, once again, we've seen this movie before, negative interest rates in places like Switzerland, Japan, Germany, and so on, even in France, all of a sudden the yields in the U.S. look extremely attractive, even with the need for many of these investors to currency hedge if they're going to invest. So those things tend to support a strong dollar, which means that you can have good investments overseas, but when you translate them back into dollars, as they are in your performance reporting, they won't look as robust, for sure. Just to tie something that you heard yesterday. Anything else, or are we done?
Mark?
Yes.
So, the phenomenon of the inverted yield curve being a predictor of the recession, literally, I guess, it's just the difference between short-term and long-term rates is narrowed and then crossed. How does that relate to the recession? What causation nexus is there?
In and of itself, it doesn't create the recession. It's an indication about investors' expectations.
And other than that statistics, why? Oh, it's expectation?
Yes, the inverted yield curve doesn't in and of itself cause a recession, although if it were strongly inverted and, for example, during the Volcker years, and short rates were extremely high, it could definitely have an effect. But mostly it's a signal about what the expectations are for investors. They're saying slower growth out in the 5 and 7 and 10 and 30 year. So I can buy fixed income out there, push those yields down because it's going to be okay. They're going to be attractive because the equity markets will be not as attractive as they are today, and people will, I'm trying to get ahead of where investors might be. So it's not necessarily a driver of recession, it's more a signal of what the market's expectations are.
So the market's expecting a downturn in equities?
In economic growth, which may result in a decline in equity values, or at least a pause in them. So you have two, let's talk about the portfolio a little bit. You have two items in front of you. You have the executive summary, which I'll start with, and I'm going to focus pretty much exclusively on page 5. And then we'll talk a little bit about the larger book that you also, I hope, have that goes into more detail in the portfolio. I'm going to talk a little bit of baseball here. We don't usually spend a lot of time, in particular me, talking about the most recent quarter. The reason is, as a presentation that we gave probably a couple of years ago, the quarters jump around like crazy in terms of the performance of the portfolio. What you really care about is what's the trend line over time. And so normally, we don't necessarily see a lot of information that we want to bring to your attention in the current quarter. And so we tend to focus on the trend lines, the 1, 3, 5, 7, sometimes even 10 year. And it's very similar to how you can't judge a baseball player by a single at bat. You need to give a baseball player 200 or 300 at bats before you figure out whether they're going to be a 220 hitter or a 350 hitter. I saw that. And
Remember, you used one yesterday.
no. Well,
Somebody else used one for you.
that's right. I was unfairly tagged. But sometimes, if you're a baseball scout, a player can do something in one at bat that has informational value. So, for example, if you're scouting a player and at an at bat, they hit a ball 440 feet. Not even many great major league players can hit a ball 440 feet. You don't know whether or not that's the only time they'll ever do it, but you know that they're capable of it. And so we look at the fourth quarter for the portfolio as not so much a determinant of what's going to happen, but it has some lessons associated with it that we wanted to call to your attention. I mean, we've got probably 15,000 statistics in this book, and we have to choose what we want to call to your attention. So if you look at page 5, and you look at the top table, one of the things that you notice here is that look at quarter 4 and look at the disparity between small cap, where you heard yesterday that you have a persistent small cap overweight, a very rational one supported by a lot of research over decades of market history. But notice that it was not a bet that happened to pay off in this particular quarter. Notice also, if we move down to the second panel where it says the total fund performance, this I really want to focus on because it ties back to some of the things we've talked about in the last couple of years. So, for example, we've always said there are 3 ways to answer the question, how are we doing? We being the portfolio, we being the board responsible for the portfolio. And we've always said, I was always taught in graduate school, well, compared to what? So let's look at these numbers in this panel and say, first of all, compared to the actuarial benchmark. Well, you can see that over 7 years, the fund has really done a great job delivering on the actuarial benchmark. Over 3 years, it hasn't done a bad job either. 5 years, a bit short. But notice the flip that has occurred in the calendar year to date and the fiscal year and certainly the quarter. There's been a flip with respect to the contribution of the portfolio to the long-term funding objectives. Very short term, nothing to get terribly excited about necessarily for a period so short. But it is a change in what the board has seen for the past 7, 8, 9 years where, as you can see, for 7 years, you've exceeded the actuarial benchmark. The second thing, the answer to the question, how are we doing, versus compared to what, is versus execution expectations. And that's seen in the third line here, where the difference between the total funds performance and the total funds benchmark. If you notice that over those 7 years, go back to the far right-hand side, where you killed the actuarial benchmark, where the fund did its job and then some, it actually had a shortfall annually of about 22 basis points against its execution expectations set by the benchmark. Well, that has flipped as well. If you look at the, say, for example, the fiscal year to date, it's gone from negative 22 per year over the last 7 years to suddenly a positive 2.5% in an annual level. I wouldn't get too excited about that, as we're going to explain in a moment, but notice, I mean, that is a huge difference in this particular measure of how are we doing. The third measure of how are we doing, or how are we doing against peers. And you can see, again, looking at whether it's 3, 5, or 7 years, that you've always been versus peers. This portfolio has performed above median, sometimes way above median, sometimes in the top 5% of peer portfolios. That has flipped as well. That's a reflection of the fact that one of the big drivers of success in the portfolio here, the strong overweight to U.S. equity, has not paid off here of late. And so that's a big flip as well. So one of the questions you want to ask yourself is, which one do you care about the most? We have always said that you should care about the actuarial, how are we doing the most, because that determines the health of the pension system. The problem there is you have the least control over that. Most of the absolute return of the portfolio is driven by what happens in the capital markets and is not terribly affected by anything that you do except your asset allocation. Versus execution, how much should you care about that? I think some, but remember, it is very benchmark sensitive, and we'll show when we go into more detail about this flip from a negative 22 basis points to a positive 2.5% in the execution metric, why you should care about it, but you shouldn't get too obsessed by it. And at least you should understand what's behind the numbers. And the third thing is compared to peers. Your peer comparisons for many years have been outstanding. But keep in mind, that's of no particular benefit to you, because they're chasing their liabilities and their benefits that they have to pay. You're mostly concerned with yours, which is why we say the actuarial benchmark answer to the question is, how are we doing is the most important at the end of the day. One of the ironies is you have more control over the other two issues than you do over the absolute returns of the portfolio, which are largely driven by the capital markets. If we could turn to page 6 in the larger document, which says on it quarterly investment performance analysis, and it doesn't say executive summary as the one I was just talking to. So if you look at this one, you can readily see in the top two panels the net and gross.
Hang on for a minute.
Okay, page 6, the bigger report, it's a little thicker.
Right.
It's a quarterly investment performance analysis.
Numbers rather than pictures.
Oh, and it's in tab 10 of your book. I apologize, tab 10.
Well, it's in the right tab.
Yes.
Yeah.
Did you get it?
Second book in tab 10.
Second book in tab 10, exactly. Thank you.
There, Jim? Good, thanks.
Okay. So again, looking at the top two panels on page 6, you can see the flips that I've been talking about. The flip in absolute return, the flip in execution versus benchmark from negative to positive, and the flip in peer rankings. And one of the things that we have said for some time with respect to the execution benchmark is don't get too excited about the fact that your peer rankings are high, but you're trailing your benchmark because you have a significant allocation to private equity, and it lags. We've had that discussion before. You have changed your benchmark to more focus on the areas that your private equity portfolio focuses on, but it's still a public market benchmark. And what you have heard us say is that you'll see your private equity performance versus its benchmark go way up when the public markets stop going up so quickly and start flattening out or going down. Well, guess what? Let's find that page because it actually has occurred. If we go to page 18, take a look at the top of page 18. This is your private equity pool measured on a time-weighted rate of return, not the internal rate of return that Ethan and his team use, appropriately so. This is the method that allows it to be incorporated and put on an apples-to-apples basis with all your other asset classes, which for the most part are marked to market on a daily basis. So take a look at how your private equity portfolio asset class performed against its benchmark in 7 and 10 years. You can see the drag that it was creating, and it was big enough that even if your other asset classes did well, this could make your portfolio and the total fund basis look like it was not being executed well. Now look at the fiscal year. Look at the difference between the benchmark, public benchmark, which had big negatives, and your private equity portfolio. So it has flipped completely. And now it is for this current short period, it is a huge driver of that better 2.5% that you saw in terms of the execution measure of how are we doing. And we would say be no more excited about this than we cautioned you not to be too excited about the fact that the private equity portfolio is tending to pull down the execution measure for the total portfolio. This will pass, and over time, it will even out. But it was one of those things where we said this was going to happen, and we didn't fully appreciate how much this particular quarter would kind of bring that home in terms of the prediction that we made. So let's talk a little bit about the rest of some of the other aspects of the portfolio. One of the things that caught our eye is on page 11. As you know from past times when we've been here, we often talk about this as one of consultants' favorite illustrations of return versus risk. This is page 11, upper left-hand corner. This is what we call the cloud chart. And this is where we try to show returns earned versus peers out there in the marketplace, but also risk taken versus peers out there in the marketplace. So let's drop down to page 12 and look at that cloud chart and notice that that you lie over 10 years in the upper left-hand quadrant. This is a great place to be because you're to the left of that vertical line, which means you're taking a little bit less risk than the median fund, but you're getting some more return. That's a good place to be. It's the best place to be. You have come into, over the last 5 years, when we add this particular disruptive quarter into it, where you're still earning a return that's above your peers, but now your volatility risk is slightly to the right of the median fund. Is that something to be concerned about? Not necessarily. You are earning a commensurate return for it. But we pointed out to the board because it is a change. Again, one of the things that struck us about this quarter was there was an opportunity to point out differences in beginning trend lines. Now, whether they continue on over the next 2 years, to be determined, but that's why we look at this every quarter. The other thing that's interesting about the chart on page 11 is that your benchmark itself is actually much further over. You have outperformed your benchmark. You can see that because the green diamond, which is the actual performance of the fund, is less risky and has a greater return. That's to your credit, that's to Joe and his staff's credit. It basically means that you're doing better than the collection of reflective benchmarks that would be essentially reflective of your portfolio as a whole. There are things that Joe and his staff are doing that actually are, on an execution basis, are making it better than the benchmark itself would have indicated that you ought to, so far. And that particular gap is one of the biggest gaps that we've ever seen. Part of this, I think, is in conversations with Joe over the last year, for example, when you're a cash flow negative institution, when you've had to pay benefits, he's tapped into essentially the highest valuation part of the portfolio, and the one that it was most overweight, had the biggest weight, which is U.S. equity. Those methodical management decisions of the portfolio are one of the contributors for having execution be better than the simple expectation that would come from the benchmarks.
Yeah, so you're saying that in looking at page 12 versus page 11, that one quarter was responsible for pulling us from left of the vertical line to right of the vertical line, or did I misunderstand?
Well, keep in mind, the answer is a partial yes, but the other is the bottom chart covers a 10-year period. The top chart focuses 5 years, so that the last, the quarter would have a disproportionately large effect on the shorter time.
Page 11 chart.
Exactly, yeah.
But a quarter ago, we were in the upper left
Yes.
hand quadrant. So Bruce's
My
question.
bigger point is that quarter, had kind of a disproportionate effect.
It did.
The 440-foot home run, although this was like a 440-foot foul ball.
I'm not getting charged for that one.
Just see what you say, and then I'll decide whether it's
Man, the power of the gavel here.
But the quarter was a big influence, but the year itself also. I mean, the year was
Yeah, keep in mind that
I'm talking about the influence of that period of time and not how our folks did. It's like, woof.
Well, but part of remember, we work for the board. We work with Joe and his team, but we work for the board, so part of our duty is to make sure that if there are trends in motion, that you're aware of them early, not to get overly excited about them, but to understand why that's happening. And to go back to Mike's comment, yes, a lot of the pain of 2018 was focused in the fourth quarter, but one of these 5 years was actually a negative year in the equity market, which is quite different. The other is that keep in mind that when we look at 5 years, years roll off the back end. So I did not check to see what rolled off, but a very good quarter might have rolled off the 5-year period. So, but it is different, and like I said, one of the things we decided to do this time was to try to point out things that were happening, at least initial things that were starting to happen differently than what this board has seen over the past 7 years, to get attuned to it.
I'm hearing you say, don't get that concerned about either of the illustrations you've given, but at what point should there be a little bit more concern?
It's less a question of time than understanding why. So for example, one of the things that, if you turn to page 16, you can see, for example, that look at the top line, look at the performance of your equity, your domestic equity composite, as well as your international one, but let's focus on the domestic one. Those are not great numbers. But the question is not how long so much, but why is this happening, and would you expect it to persist? So there were two factors that made this happen. One is your active managers did not have a great period here in the fiscal year and in the quarter and in the trailing 1 year. But the other one was structural and had nothing to do with your manager's performance. It had to do with your choice to be have a large reflection of small cap stocks. And one of the reasons I started the conversation by pointing out that big difference in the performance of the broader market and small caps. So if unless the institution would come to the conclusion that that having this strong emphasis on small caps strategically for a long period of time didn't make sense, a portion of this relatively poor performance does not lead you to go out and churn managers. It might, and you ask if it continues. If we were to be in the fourth quarter of this year, and we were sitting down with Joe and his staff, and your staff does an outstanding job in almost real time watching your managers. If it were to continue, there would be conversations about the structure of the domestic equity portfolio, similar to what we had, 6 or 7 years ago. And you'll recall this, and I think Jack will as well, when we built working together, we built the large passive cores. And yesterday you saw in the international one that your staff is actually very careful about not churning managers. That's an expensive process. Every time you churn a manager, you essentially pay a toll to change horses. And I will say that when we look to the managers, to just anticipate a question that I know Jack often asks, there's no one manager that jumps out and says, this is because of them.
Okay, so you almost got my question, but here's it. We have heard in the past that some of our managers will protect us in a down market. And I know you don't want to put too much emphasis on one quarter, but that didn't seem to happen.
You are correct about that. That is one of
Mark that down.
And you are correct about that. And by the way, when we scan the performance reports of quite a lot of clients that have value managers that we might have expected to perform better in the fourth quarter, they, by and large, some of them did, some of them didn't, but many of them didn't. Understanding why that is and whether it'll persist, I think, is one of the challenges that Randy and company have, as well as ourselves. But your observation is right, and it's not just about this fund. It is pervasive across that segment of the capital markets, the value side. However, let me show you an example where the conservatism and the value and the protection that has dominated some of the thinking of mandate and manager selection actually paid off. And let me see if I can find it. It's in the fixed income section, and it has to do with your high yield area. So, page 16. You have heard your staff, and we agree with them, that there's been a bias toward selecting conservative high yield managers, because there's always a spectrum, particularly in something like high yield, which is you can go from very large amounts of credit risk to credit risk that is higher than normal than you would see in investment grade, but much closer to investment grade. And your staff has tended to select managers that tend to be on the conservative side. So if you look down on page 16 and you look to high yield, notice that in the recent quarter and fiscal year to date, there's actually been a flip to the positive versus their benchmark. And I think this is what you would expect, given the bias that has been articulated by your staff over this period of time. This shows that what they have been saying is being borne out. And in fact, if you look at, I'm trying to find the right page where the managers in the composite are laid out, almost all of the managers contributed to that positive performance in the high yield area. So in contrast, Jack, to your question about value protecting asset managers in the equity space, both international and domestic in the fourth quarter, what appeared wasn't exactly what we'd hoped to see, but it doesn't mean that it won't appear. It just means in this 3-month period it didn't. But it did appear, and consistently so, in the high yield segment. So I hope that's responsive to your question.
Yeah, very good.
Okay.
Well, but you didn't. Why didn't it?
Well, that's, we're working on that, because I will tell you that there's no one obvious reason why that's the case. Some of it has to do with value managers have been punished over a 5-year period. I think Randy will tell you, growth has, the FANG stocks, Facebook, Amazon, and so on, have surged ahead. Growth stocks generally have surged ahead of value for a number of years. And one of the things that we're doing in our shop is trying to go back and say, were value managers tempted to sort of get a little bit growthier because they were losing so much absolute performance ground to growth managers? Another is the fact that value managers tend to be very, very sensitive to fundamentals, because they buy companies that are values for a reason. There's usually some problem that's being worked out, or some thing that is not very appreciated by the equity investor marketplace. So they're very fundamentally oriented. And as Mike just discussed, during this period of time, we went from a Fed that was raising rates to a Fed that got worried about it and started talking dovishly, so much so that the market set expectations for no rate increases for 2019. And once again, we saw a mini version of what we've seen so often in the past 7 or 8 years, where the equity market dances almost too much to what the Fed's going to do. I don't know what too much means, but we know that it's had a profound effect on equity values. And I don't know, Randy, you can ask Randy his opinion on this, but I've heard him talk before about it's very difficult sometimes for stock selectors who base their work on fundamental analysis of individual companies to get full realization of their stock selection skills. But like I said, if later this year we're seeing the same phenomenon, I would expect Joe and Randy and your staff and ourselves to sort of huddle up and say, hey, what's going on here? Is it something different? Are we not picking up something? But for 3 months, that's like judging a baseball player by a single at bat. Not a good idea.
Okay, circled around.
What's that?
He circled around.
Right.
Yeah, but it was the same metaphor.
That one counts as the same. But there are no
Horses.
There are no horses in baseball. It's like there's no crying in baseball.
Wait a minute, what about horsehide on the baseball? I'll work on that, I promise.
You really don't need to.
So, are there any questions? I did want to say, I know that some of you are coming out to visit our headquarters. We're really excited about that. I hope that your fellow board members said that was a worthwhile trip. And we like it because you see Becky here, you see me here, you see Mark, you see Mike. What you don't see are the 15 or 20 people that your staff interacts with episodically, depending on what they're choosing to work on at any given point in time. And I hope that gives you a sense of the depth of the ways in which we can help the board, but also the staff. And I don't want to go like I said, this was an unusual presentation, particularly by somebody like me, because we focused so much on the quarter. But again, I thought it was a good idea because there were so many changes in direction here that it was a good time to highlight those. And in case that we find ourselves in the fall talking about the same things, then now all of a sudden we may be talking about it. With that, I'll stop.
Okay, questions before we?
Questions?
Yes.
Recently, in the last week, last couple of days, we've seen a change in the market. How would you anticipate that would change performance?
In a very positive way. I mean, we had the best equity market performance in the beginning month of the year in January that we've had in, 30 years. And it wiped out a lot of the declines that occurred in the fourth quarter. So if nothing happened over the course of this year in any particular way, it would clearly have a very positive effect. And it's one of the reasons, I didn't mention it, but it's one of the reasons not to get too excited about a single at-bat in the quarter. Whether or not these are sustainable, we'll find out, but it has been a remarkable comeback, but it doesn't change the desire on our part to look into the fourth quarter and try to answer the questions such as Jack asked, which is what kind of behavior occurred even in this very short period of time, and does it have any informational content, or should it be swept aside as noise?
Can I add one, just about this, only because I think it's worth noting that, yes, equity markets have done well. Yield markets have not come back to where they were, so that's a lot of what we're also going to do is kind of goes back to the yield curve discussion, seeing the same response that we got.
Okay, anything else? All right. Joe? Tab 11.
Yeah, we're going to be in tab 11, investment update, but before turning the pages, just a few thoughts, right? We started the day with John and Kirsten reviewing STIP and actually doing a trade. Very short term, very specific, very important. The conversation we just had from RBK focused on a quarter, right? Very important, very significant, but both of those are key parts, but don't describe what the focus is of what we do. And what we do and what we are long-term investors. And so I could spend the next hour talking about the quarter. We're going to review this, and part of what we're reviewing is the quarter, or what happened today or yesterday. But more importantly over time is we don't look at the most recent thing and even try to guess, is it a change or is it a continuing direction, but look at longer term trends, and as important, look at our day-to-day policy, process, and procedures, and think, are we executing on those and making it better? And because if tomorrow we looked at year-to-date statistics, just take everything that was just reviewed in the quarter and reverse it. And therefore, where are you? You really haven't made, much progress, right? Our progress and our objectives is the progress we make over the longer term focus and with the infinite horizon of the pension plans, the trust, and STIP. And are we making progress towards those longer term goals? So I don't believe anything really important here has flipped, right? We Come the fourth quarter, we lived it day to day. We looked at screens, we understood what was going on, but we didn't change what we were doing, right? And so we didn't, and I think that's critical, because clearly a lot of people did. A lot of people panicked, right? And their emotions drove kind of what actions they were taking, and that in turn influenced what happened to the market. But there's no way you can look at the fourth quarter and also look what's happened year to date and say, oh, we have efficient markets, right? And everything is priced in. Clearly emotions play a huge impact, right?
And is that, how do I put this? I mean, there's a segment of the market that isn't in there for the long term, right?
Sure,
Yeah,
yes.
and how big is that segment?
I have no idea how to give a precise
Right.
number, right? It's probably grown with technology. It's probably, but as a long-term investor, to a certain extent, I hope it grows more, right? Because if there were people not trying to do what we're doing as long-term investors, but focus more on the day-to-day, then there should be more opportunities for us thinking over the longer term. I would say the same thing about active management versus index management. There's benefits of both, but I fear a world that everyone uses only indexed management, right? Because then the people that decide what we're gonna buy are the people constructing the indices. And as you found out yesterday, that Steve went through with those rules with MSCI, they're not so straightforward, right? They're not so passive. They're very kind of rule-based. They're very thoughtful, active decisions that were made. But there are trends, short-term and intermediate, that benefit our longer-term focus, but some work against that. And we have to recognize as we move forward through the shorter and intermediate periods, which things we'll take advantage of and which things we actually shouldn't spend too much time on. But so again, I hope as we go through this presentation, the focus is on the long term. But I don't mean to neglect in any way or suggest that the team isn't focused on the short term. Every day we come in, we're focused on how can we get better? What can we do to improve things for the longer term? So that is occurring all the time. But our focus is on the longer term, and the metrics we're going to use to say are we successful or not, or are managers successful, are going to be tied to the longer term. It is not going to be something that is shorter term based. And I haven't thought extensively because I just heard Jim say it for the first time, but the word flip to me, could sound somewhat permanent, right? Oh, we got here and it flipped, right? Well, what's the difference if you flipped and flipped? It's almost like nothing happened, right? And so yeah, so I wouldn't read too much into some shorter term market actions, because at the end of the day, it is more reflective of our emotions as it is the fundamentals of the market. And if we get convinced that it's always going to be this way, the world has changed, that we're never going to see negative returns, that's as bad as thinking, oh, it just changed and now it's just going to be horrible and it's flipped, right? The reality is we experienced unusual years. Last year 2017, not 2018, you know, we told you it was unusual, low volatility, right? What we saw in 2018 over the entire year, not extremely unusual, the quarter was very unusual. And you'll hear more about that and after I step back and Dan and Aaron come up and talk about that. But I just want you to keep those things in mind, that we are doing the same thing, improving our process, improving decision making, focusing on the long term, independent of whether the market seems very stable or very volatile over shorter periods of time. So if I can take you now to the presentation, I'm going to run through the first few pages very quickly. Again, we intentionally, you know, on page 4 that shows performance, you know, over time here, we want the focus to be on longer term performance, right? And so you may or may not have noticed, but over the last kind of year or so plus, not showing a quarter return here, right? Had I shown that, everyone's eyes would have been looking at that quarter, just as you just looked at that information as we went through the RBK materials. But you look at the 1 year, and if I said, oh, the 1 year number is minus 2.63, right? Is that good? No. You know, that's not as good as we would want. But is it horrific? You know, should it change what we're doing? Is it unexpected? No, it's within one standard deviation, probably a half a standard deviation of the portfolio. So when we get to April, we'll talk about asset allocation, expected returns, and standard deviations. This is pretty much in line with expectations. It's not a surprise. And as Jim pointed out, as you look at the longer term returns, the good thing is that 3, 5, 10, 20, you know, since inception are all positive, don't have a negative number. So those are all clearly better. Some of those are better than others. Yeah, the 10-year number is ahead of the actuarial number, but that really doesn't help us going forward, right? That's a good number, but we're in a more challenging world. 10 years ago, right, we were at the beginning of 2009. We were at an inflection point of markets. We were coming out of a few horrible years. Things were priced very cheaply. It is going to be difficult right now, looking forward over the next 10 years, to produce that number, right? But that is not too far above our actuarial assumptions. But our actuarial assumptions are not a 10-year number. It's a 50, 40-year number, right? So again, we are focused on absolute returns. If you get too focused on benchmarks and peers, are more difficult, right? Because who knows what they're doing and why they're doing it. And by the time we're making decisions based upon their numbers, they're probably changing what they're doing. And so what we can control is what we're focusing on, and why we will continue to focus on asset allocation and manager selection primarily. So yeah, disappointing 1 year, but overall page 4 is feel pretty good about, but it is going to continue to be a challenge as we look forward. Page 5 tells a mixed story. The first frame on page 5, 1 year, you'll see that the pension plans, you know, were down from 11.5 billion to 10.9 billion. And you say, oh, wow, the markets were horrible. No, the markets weren't good, but most of that decline, the 409 million, is that we paid benefit payments. Well, that's not a problem. That's what we're here to do with pension plans, right? It's something we expect. And now we hope over longer periods of time we'll see frames more like the 5-year and the 10-year, with what we send out is kind of dwarfed by the value added in the investment return, or the remaining dollars that stayed in the pension plans. But yeah, the 1 year was challenging. We lost some ground against our longer term objectives. But as we focus on the metrics for our longer term objectives, and we look at the 5 and 10 year, no matter which page you look at, 4 or 5, things are in decent shape. But we shouldn't, get too comfortable, right? Because we do expect, as we look forward, markets and our job is just going to get more challenging. Page 6 is just showing the difference across the plans. Again, the majority of that, the decline in dollars, for most of the plans, particularly the 2 biggest, was dollars coming out to pay benefit payments. Page 7 is always interesting to look at, especially the 1 year cash is king, right? And Kirsten and John talked about that. Some good things happened. We went from hardly fractional yield in STIP to now above 2%, right? That is reflected in that 1 year number. And then below that, the next 4 boxes or so between the LIBOR and PERS, you'll see all fixed income benchmarks, right? Again, you look at those returns, you don't get real excited. You wish you had all the assets in cash, right? Very different from what we've thought over the last decade in fixed income. And then down the bottom, you see everything equity oriented, really driven by what happened in the fourth quarter. But some of our longer term biases that have helped out our longer term numbers, whether in absolute returns relative to peers, still have worked out, right? So yes, we are overweighted U.S. equity and small cap, which didn't do well, the third box from the bottom here. But the bottom on the 1 year is the non-U.S., right? And so we benefited by not having as much there. Could that turn tomorrow? Sure, right? But the challenges we have in this country aren't necessarily unique. They are global. And more importantly than talking about those challenges or opportunities is what does the market think of those and what is priced in. And so our positioning in our portfolio and as our managers buy securities, as our private investment GPs execute on their strategies, it's more about executing what's already priced into the market and how to do that than it is really thinking about the economics of it. Because we're going beyond just trying to buy a good business. We're trying to buy good businesses that are priced either fairly or cheaply. But again, 7's always a good thing to, page 7 here, to look at these asset classes in the mix, and that's why we don't put all the dollars in one asset class. This is why we are continuing the trend we've done over the last few years, and I expect for 2019, that our largest asset classes will become smaller and allow some of the smaller asset classes to get greater. We're in the process, continuing the process of continuing diversification across asset classes. We're not gonna look at an economic view or look at what the yield curve is predicting and predict a recession and say whether that is also going to predict the market. We had a huge downturn in the market in the fourth quarter. A recession didn't happen then, right? No one, it had nothing to do with the prediction of the recession. The market, there was just so many uncertainties, and the market had priced a lot of good things in and then backed away from that pretty quickly, right? But very few people are believing there will be a recession in 2019. Not everyone, believes it's not going to happen, but most of the market participants are thinking further out than that. But those are the same participants that in 2015 said, oh, there's going to be a recession in 2 years, right? And here we are 4 years after that, and they keep pushing that out. So we're not going to spend a lot of time trying to guess, how many months away the next recession is. If the market gives us opportunity to make investments to get to our longer term objectives, we'll make that. If it works out well for us, we'll take some dollars off the table and reposition ourselves for a different day. So that's how, bigger picture, the strategies we're employing. Page 8, we are in line with all the policies, nothing significant to talk about there. More interesting is page 9, is within the policy ranges, how have we changed? And you'll see the biggest change is domestic equity. So clearly some of that minus 4.41% is the fourth quarter decline in equities. But as important, throughout the year, including the fourth quarter, we took dollars out of U.S. equities and placed it other parts of the portfolio. In some cases, other types of equity, like private equity or real estate, you see they increase into diversifying strategies that has some equities, but not as much kind of equity exposure as our domestic equity. And we also increased the cash equivalents a little bit year over year. Most of the fixed income you see kind of washes out. Certain types we added a little bit, and the other types we did subtracted a little.
Was the, excuse me, the change in equity all planned, or is it part of the denominator effect? I think I'm asking that question right.
The answer is both, right?
Yes.
So starting the year and starting this year, right, we have a plan to reduce U.S. equities. Starting the year before, right? But the year before that, we had that plan, but actually year over year they grew, right? That didn't mean we didn't take dollars out of U.S. equities, is that the market return did so well. Last year, we started it in similar fashion, and we were raising dollars out of U.S. equity during the year. Yeah, when we got to fourth quarter, things happened sharply. That didn't change our plan, right? We didn't say, oh my goodness, look what was happening in the market. Let's take out more, let's take out less. We took out, kind of along a disciplined path, some more dollars out of U.S. equity.
But what I'm asking is, so the downturn in the market took dollars out of the U.S.
Sure.
equity, and so you just incorporated that into your plan, I guess, or did you just, you know what I'm saying? Did you say, well, we've already covered it because there's been a downturn? Or did you say, continue on the same path with
the latter. So although the dollars in U.S. equity went down, we didn't necessarily stop actually taking dollars out. We continued to take dollars out of U.S. equity.
At about the same rate you had planned to do? So
approximately the same rate, yeah. And we continue to do it this year. As the equity valuations went up, right, we have taken some steps. We haven't viewed that, oh, wow, everything's good again and it's flipped and we're gonna see 20% returns this year.
So how far, if I may, excuse me for interrupting.
Yeah.
How far in the future do you see that plan taking us, or hasn't been determined yet, or?
Hasn't been, but if you look at page, no specific date, right? Because things are always being reassessed and we say how we could get better. But if you look at page 8 here, right, on the top, you'll see as of 12/31, our allocation to domestic equity is 31%.
Mm-hmm.
That is approximately double what's in international equity, which is the second largest allocation. So expect as we move forward, assume markets remain flat, right, to neutralize the market impact, that more dollars will come out of U.S. equity and will go to these other areas that we're building out, right? To have the portfolio less concentrated in U.S. equity. The reason there, not to the extent that U.S. equity is even going to fall below non-U.S. equity, right? It's still going to be our largest asset class, right? This is incremental changes in a strategic direction to try to get us to an actuarial return that's more stable, right? And not have us beating or not beating our actual return to be singularly defined by what happened to the S&P 500 in 1 year, right? So spread it out, do a lot of different types of strategies with a longer term goal to get there. And part of the reduction is that US equities have done extremely well over recent periods. And we're not going to shy away from them, but we have reduced them. Part of the reason why we've reduced them is we need to pay benefit payments. About 3% a year is coming out of this pool of assets, and we need to decide where to take that from. And the decision 2 years ago, last year, and likely this year is, well, take it from the biggest pot of money, because that seems at best these days fairly priced.
Thanks. That's helpful.
So, and then more to come on page 10. Those are just the cap asset class returns. But as we go forward, you hear others speak, they'll detail a little bit more about the returns and thoughts on those. But I would even tell you this 1 year is 1 year. I again, respectfully disagree with Jim. If we get to the end of this year and we see that 2019 was a negative year and certain of our managers underperformed for 2019, don't expect something radical just because of that, right? We're gonna look at the longer term going back and look forward and have some expectations. So we are not gonna ignore what's going on, but I would ask you to decrease the emphasis on a 1 month, 3 month, even a 1 year or 3 year type return, to recognize our goal here is multiple decades. And our process and our decision making, both at the asset allocation and manager level, is based around that longer term focus, right? If we were shorter term focused, we would have a different process and set of procedures. So happy to take any questions, but given time, and apologies for taking more time than usual, but I'd like to turn it over to Dan and Aaron on risk management unless there's any questions that the board has.
I think just one thing that needs to be pointed out to the board, if you go to page 6, remember that last year we had quite a bit of noise coming out of the special session relative to PERS and the judge's retirement system. So within PERS, you had fewer contributions from fewer employees paying in, because you had large vacancy savings rates, you had RIFs, you had fundamental changes within the enrollees within PERS, and fewer were coming on board. Within the judge's retirement plan, there were no contributions made. Those contributions were frozen for 2 years, so that and that money was kept within the state coffers. So there was some noise last year as well within these two systems in particular.
And I think that's a good point, but that is something that is easily managed by us, right? I don't, the systems and the different plans can make the decisions on contributions and benefit payments, and at the current level for all these plans that we're overseeing on the pension side, there's nothing that's happening there as dollars are coming in or being taken out that is concerning and detrimental to the longer term investment focus we have. We are looking at all those different changes plan to plan, and once we get here, somewhat neutralizing them, right? We're keeping a similar cash balance for each of these plans, a similar asset allocation for each of these plans. So those decisions we become aware of over time, but we just incorporate and really are not a huge challenge from an investment perspective. All the challenges for those issues deal, with the plans themselves and with the legislator and the budget office, but they don't really cause us many issues.
John, a question sort of the opposite of what you were just saying, and that is, if the pension boards had chose to reduce their assumed interest rates from middle sevens to middle sixes, how would that affect the management of the money in those funds?
My personal view, I'm gonna give, if they did that, right, there are some consequences to that. If you do that, then the plan status is more underfunded. My guess is the actuary for the plan would recommend to the plan and the legislators that additional contributions would have to be made, right? And assuming those actions took place, right? And then, so assuming then our goal for a 40 or 50-year return is a lower return number, that changes our objective, right? And so we would likely, over time, assess that based upon our expectations. Now, in that particular case, that change would get close to our expectation for this asset class mixture over the next 10 years. So it really wouldn't change our current strategy. It would just more align our 10-year view and our 40 or 50-year view, right? But it wouldn't, that would have greater impacts to the plans and to dollars within the state, but if that decision were made nearer term, it would have very little change to our current investment strategy, because as Jim and RBK will review in April, update on asset allocation, and the numbers will change a little bit from last year, but the number last year was more in the mid-sixes as we look forward a few years, right? So if we change a number down a little bit on the actuarial side, it's not going to change too much what we're doing here at this point in time. More meaningful would be if yields in the fixed income markets normalized. What I mean by normalized goes back to a level that's kind of average for whether you say the last 10 years or the last 20 years, just think a few hundred basis points from here. If we did that, we'd have a lot more fixed income securities today and not be as equity heavy. And there'd be benefits to that, but everything that Mike and Jim said is, as the markets right now are thinking that's less likely, right? As the yield curve flattens and maybe inverts, that's not really a market that's focused on rates going up a few hundred basis points from here. Any other?
Who's next?
So turning it over to Dan.
Dan. Run on up here, Dan.
Yeah, give me a minute.
Scoot up there. We need that polarized. I've got paper on this.
How you feeling, Dan?
Oh, good, thank you.
Sorry to see you.
That's all right.
Not looking to sue somebody.
We discussed it yesterday. It was a downhill ski racing. Right.
Jumped off the chairlift, right?
No. You jumped off the jump. Right, and landed wrong. We'll go with that right there.
Yeah, no, that's a great story, I appreciate that. So, Mr. Chairman, board members, so the risk management team, which is myself and Aaron, we wanted to start with a return analysis this time. And the reason for this is to try to give the fourth quarter market performance, to try to put it in a perspective, put it in a historical context, and hopefully give some color on what Joe was saying. Hey, it was an unusual quarter, but how unusual was it in a historical context? So, in this analysis, we have to take monthly returns, and we use the S&P 500. It's a good proxy for the market. The data that we have goes back to 1970. And then you take your, essentially, one starting point is you take your monthly returns and you start looking at it in different time horizons, such as a 3-month time horizon, a 1-year, or a 3-year time horizon. And how this works is that on a rolling return basis, you calculate a 3-month return, for example, and then you move it forward 1 month, and you calculate another 3-month performance. So by doing this, you, it's much easier to see trends that are persisting. And again, when you do this, you're doing this for each of the time periods, you're kind of moving it along, and you generate lots of observations. And so, you know, when you're doing it for like a 3-month return, for example, you have over 580 observations. So I think that does qualify this as a big data analysis. But, you know, we have a long time frame to work with, and it basically allows us to see what the historical returns, what their distribution is, what's the range, and what should you expect. So, you know, on slide 11, I'm just going to kind of jump over in the sense that I don't think it needs any comments unless you have some questions. But what I'm really referencing right now is the chart on page 12. And again, so here's the context. And when I look at this, what's helpful to me is if I just look at the 3-month time horizon, I'm looking at those extreme tails, for example, the positive tails and the negative tails. And so what jumps out at me is that what this table is telling me is that there's a number of occurrences of, say, 20% or better. It happens 1% over this entire time frame. So we're marking every occurrence when you have a 3-month return, 20% or better, and then figuring out that percentage. Alternatively, you can look at that 20% or worse, and it's showing that it's 1.2%. So this is, again, you can kind of, it's showing you how many times it happened, and you can add up these percentages to kind of see how often a particular return, and you can stratify that really any way you want. We kind of gave it a fine delineation here, but it gives you a sense for where does this fourth quarter fall in, and you know, you can see where we highlighted in yellow that in this fourth quarter it fell into the -10 to -15%. That happens, you know, 3.4% of the time. Again, that's I think that's helpful to understand that there's some other returns here that, you know, happen more often. Or another takeaway here, an observation would be when you look at that whole spectrum of 3-month returns, you know, the negative returns, you know, anything below 0, let's say, it happens 30% of the time. So those are pretty good odds when I think about that 70% of the time we have a positive return. And another thing that jumps out at me is that, you know, we're long-term investors, so when you start moving out past, you know, 10 years, if you look at the 15-year and 20-year time horizons, there aren't any. There are no negative returns in those long time frames. Now, you can never say never. It could happen the first time coming up, but when you look historically, in those long time periods, the S&P has never shown a negative return.
And this is 1970 to present, is that what you said?
Yeah.
The data?
Yeah. We brought it right up to the fourth quarter.
Yeah.
Let me try this once more on the rolling returns. Is this particular chart for, what's the time period? Am I reading, I mean, like the returns are over a year, or are they over 3 months, did you say, or what they?
So the returns are monthly, and your data set is 1970 all the way up to the end of 2018. And then you can come up with different time horizons for each
So
of
the
those.
20-year, for example, would be monthly returns
Over a 20-year period.
over a 20-year period and the rolling return.
Right, right.
So when you say that 35, 24%, and then you get over here to 5 to 10%, we're the 35.4%. Why, nothing below that on the chart? What does that help?
Again, because there's only so many 20-year time periods you can get out of this. 40, 50 years.
It starts in 1990 when we
Okay.
started recording that
Okay.
20-year return.
1970.
I got it now. Thank you.
Yeah.
No, the
Part of the data.
So it's 1970 is where the date.
Oh, right, well, the first 20-year return is 1990.
Yeah.
Right, because 70 and 20 is 90. Right?
Do that again. Thank you for being also one who is missing this as well.
Yeah, so another observation I would make here is that if I look at the 3-year return and I think about what's the most extreme return that happened over a 3-year time period, I mean, we're longer term than that, but it looks like there's a few returns, 0.4% that were down at least 15%, 15 to 20. And what this doesn't show you that when you start digging into that data, you find out that there's, there's 2 or 3 occurrences that happened with that type of a magnitude of downturn. And it's related to it's essentially 2 recessions, the great financial crisis and the dot-com bubble. So it's
On
right
this risk analysis, does this tell me that we should be all in stocks or a long-term investment?
No, I mean, you heard what Joe said.
I know, but this chart tells me something different. So when you have all those, on 20-year term, you don't have any negative return. Doesn't that say you should be more in stock?
Dan, if I could jump in.
Yeah.
If we never took money out, yes,
Okay.
right? So if but we do take money out. And therefore, the shorter time returns do have an impact. And so the other thing, why you have diversification not in stocks, it would be on an unusual investment team, an unusual board, not to have emotions impact them, particularly during these worst returns. And so there's some comfort in an asset allocation mix that reduces the volatility. But theoretically, if you're a longer term investor, you could argue you should have it all in equities. We are pretty close to that, right? We have 75% equity exposure. So we're pretty close to the theoretical, equities are how you win over a long period of time, but we're kind of hedging that bet with money that's needed for liquidity and also smooth out some of the, a minus 40% year return such that it's only minus 20, right? Such that people don't make crazy decisions at just the wrong time.
One thing I got, this is a historical return analysis. So in this time period, there wasn't any returns on a 20-year, 15-year basis that were negative. It doesn't mean that's not possible going forward. It doesn't look like it is based historically, but we don't have any, knowledge of that. So we just kind of manage risk as it comes.
I thought you had a crystal ball.
Wish I did.
Yeah, so what this chart tells me though, in the short term, we have to deal with some volatility, we have to deal with some negative returns, and that's just the nature of the market, and that there's going to be a subsequent rebound in returns for every time you see a market turn down. And so that's what I want Aaron to talk about at the next slide, which talks about the kind of the subsequent performance after you experience some of these negative returns.
Yeah, so this next slide, subsequent performance, this is what has happened after a quarterly return of negative 10% or worse. So 1 year after a negative 10% or worse quarterly return, one-year returns are positive, have been positive about 79% of the times. Year to date, since end of last quarter, the S&P 500 is up about 9.7% as of yesterday. So it's clearly reflecting that higher probability of strong returns following a poor returning quarter. 3 years after a 10% or worse quarterly return, the 3-year return was only negative twice, as Dan stated earlier. That was during the great financial crisis and the dot-com bubble. Any questions on that side? Moving on. So I have a few takeaways written down here, but I think the biggest one that we should think about is given this historical distribution of returns, the negative return of quarter 4 in and of itself is an indicator of poor returns coming forward.
Well, are there any other questions before we kind of move into the regular updates, so to speak?
Moving right along.
Good.
This next slide is showing what the contributors to the overall one-year cap return. Cap return over the 1 year was 2.74%. And this just basically shows what each asset class contributed to that return. Basic way to think about it is, so for domestic equity, it's whatever its return was for the year multiplied by its weight in the portfolio gives that 2.3%. And obviously the equity asset classes have been much more volatile and contributed negatively during the year.
Yeah, okay, so if there aren't any questions on the return, then I'm on page 16, and this is the slide that's trying to show you what our concentration is by managers. This doesn't change a whole lot. Northern Trust was recently added.
Dan, just because I stuck on that for a second.
Sure.
This rolling returns thing, what period of time frame was that for again? 1990, did you say that?
It was 49 years and 1 month. That was as far back as we have to date.
Oh.
So it's about 1970.
The data goes back to 1970.
Right, but it's looking at these time frames.
Right.
In,
Other questions?
no, that's it. That's all I have.
Bruce? Oh, okay. I'm sorry.
Yep, and so when we're looking through all our managers and trying to find out what their weight is in the overall pension portfolio, we're looking for concentration. And we do have some limits set up for that. And this, again, this is nothing new. It's our passive funds that typically have the largest concentration, and it's our fixed income, what we manage internally, has a large representation of the portfolio as well. So my next slide, the geographic slide, again, this is another kind of a lens that we'll take on the portfolio. We try to break it out by region, by country, currency, just to see where there are some where the balances are, or whether we have some exposures to a particular region or a particular country that, and how that shakes out. So this is telling us that we have a home bias, and I'm glad that you asked a lot of currency questions to the public equity yesterday, because I'm showing the currencies right here, and you know, we kind of use the acronyms there, but it's the US dollar, the euro, the Japanese yen, the British pound, and the Hong Kong dollar there. So this is trying to give you a sense of our exposures to foreign currency when you take the international portfolio and you look at that local currency amount and you say, okay, how much is exposed to that foreign currency, and you just tally these things up differently, different slice on things. You know, again, we're not taking a lot of currency risk when I look at that, because we are predominantly U.S. equity. Any thoughts there? So on page 18, another slice is to look at the entire portfolio in terms of sectors and kind of do the best assignment that we can for some of those fixed income securities that could go in one sector or another or has an underlying basis for these sectors. But this has given you that overall view of how would the portfolio look by sector, and one of them being U.S. Treasuries. We have a fairly large position there, and we're just trying to compare it to the ACWI World IMI kind of a benchmark, a global benchmark. And it's not the best comparison because that's an equity benchmark and doesn't have, say, fixed income in it, but it's a good representation as to how diverse we are across sectors. And we're monitoring, we're watching this to make sure that if some exposure is increasing or decreasing, we'd like to know and understand why that's happening. A lot of the managers have control or discretion over these things. It's not necessarily at this point in time that we can shift the portfolio to any one particular sector. We let the managers figure that out, and we have passive portfolios which are aligned with the passive benchmark. Does that make sense?
Go ahead.
I'll ask my question.
Yes.
So the reason no U.S. Treasuries don't have comparators or cash equivalents is because they're not included in this index, MSCI.
Right.
Because those are
If they're all in dollars.
Yeah.
That's a stock.
Cash versus, yeah. That's what I said. I was just asking them to make sure.
Okay.
Yep, and this is not a look-through basis, so, right, we're looking at every security. It's another big data project, because you got, 26,000 lines in the spreadsheet and all that stuff. So on the next page, again, this is going back and looking at our exposure. We call it top 10 issuers because, again, we're looking across, equity, fixed income, and we have to group it up by kind of the parent company. And this is how it looks so that we get a sense for, are we, for whatever reason, overweight a particular company, or are we overweight something? I say overweight, but we're interested in making sure that our concentrations are within reason when you look at it by issuer.
What's within reason?
What's what?
Within reason.
Again, people use, say, the 5%, the 5% rule, because that's our first stop when we say, hey, the manager, we want 5% cash, no more than 5%. But as you can see, it's, a lot of these securities, when you put it in the overall portfolio, it's much less than that. But that would, again, be my first stop in terms of saying, if we had a particular security over 5%, I'd want to understand why.
A lot of these countries are some of the biggest in the world, so just in passively holding indexes, we're gonna proportionally own them in the indexes. If there was a company that was a bit obscure in the top issuers, then that would be definitely very positive.
And then what happens? You run down the hall, you go down the hallway to Joe and say, holy cats, look at this. I mean, what?
Hopefully we see it beforehand.
Right.
Yes, I mean, we have a lot longer list than this. We're only kind of looking at the top 10 here.
Right.
But if there was an obscure company in one of this longer list, then we might ask, at least ask the manager to own a large position about that.
Yeah, it's an open
And then what?
communication.
It's just, it's a communication thing, or, I'm just trying to understand the process.
Yeah, no,
Joe.
so this slide is for you. This isn't something that, we would be well aware of it before we created this slide, right? And so, again, most of these exposures, public markets, Randy and team are looking at those on a regular basis and understand that. If there was, if a manager actually went beyond their guidelines, we would know that like the next day as we're monitoring it, right? And so if anything was concerning, we would have an active discussion with them. And there have been times in history in the past that managers have said, oh, we think this is great, we'd like to hold more of it, and we have said no.
No.
And they have said, oh, but we're doing it for our other clients, and we have said no. So it doesn't happen that often. It's very infrequent, but very disciplined day-to-day process for the public markets team to monitor this, and if things are out of whack, we'll take an active stance on it.
Okay, thanks.
And my last slide is my pension liquidity slide. That's one of the viewpoints that we take in the portfolio is how much liquidity do we really have when we start looking at security, and we have to make an arbitrary decision as to how fast we can think that we can sell some of these securities, but it should be a takeaway that we have a fair amount of one-day liquidity, and it ties in a lot into what they discussed about STIP and the fact that we own 5% cash and that sort of thing.
Thank you. Anything else? All right. Michael. Did I have it right? Yeah.
Covering private equity today. We'll go pretty quick. Let me know if you have questions. At headline level, their narrative is really similar to the last couple of quarters, last couple of years. Very active buyout market. Valuations are high. Leverage or debt is cheap and available, and people are using it. All of that sounds fairly scary. There are some positives, there are some negatives to it. As far as it being active, that is good and bad. In a way that's good is people are buying, so that means our managers are able to sell companies. In a way that's bad is, if our managers are buying at high valuations. Not inherently bad. I don't think we are dogmatic about the valuation levels that our managers buy at. We want them to be shrewd and frugal about it. But we care about alpha, and that's driving sales, earnings, margin expansion. Sometimes we're not going to say that we only want our managers buying at 6 times multiple. Sometimes you buy B companies or C companies, they're priced that way for a reason, right? We care about the growth of these companies within buyouts. On leverage, that's a bit of a different story. I think we're very critical about the leverage that our managers use. This is historically high levels of leverage, 5.9 times earnings as a multiple. So for someone that I mentioned yesterday, a Treeline, which is a debt provider, they are generally coming in at a 3.5, 3.7 times. So 2 times lower leverage than the market. So we're very critical about our managers using leverage. We want alpha to be driven through operations, through expanding margins, not by just using leverage. And so holistically, I think we skew away from managers that use high levels of leverage. Move on. Page 22. These are the returns. I think the team has gone over it. PE looks very strong. That's mostly a reflection of public markets and the benchmark. Keep on going on. Page 24. Now the market value on top. Portfolio continues to be very North American centric, moving towards more primaries as opposed to fund of funds. We continue to be selectively focused on buyouts. It's a very active market. A lot of our existing managers in the buyout portfolio are back out raising their next fund. We'll be heads down in the first quarter, second quarter, determining which of those we will do. It's a very high number. And so we're spending more time looking at our existing portfolio names rather than seeking new names today.
And is that because existing commitments are over, or that just our existing managers are doing so well that they're adding new funds? I mean, why is it that,
Yeah, so our managers raise in successive funds, and so the funds that we're currently in are being invested, they're doing well, and so they're back out in market raising the next iteration of the fund.
and when that happens, we've talked about this, about how you go visit people and talk to them, etc. When that happens with an existing manager, do you go and again to make sure they have the capacity to do a new fund? Or?
So we will re-underwrite as if it were a brand new fund. It's an easier, more efficient process because we know the manager, we should know all the portfolio companies, we should know their investment style, all of that. For the most part, we will visit them again on sites. Sometimes we won't because we would have visited them last year, had an update, or they would have been here already. But overall, it's, we're taking a fresh look at it and being pretty critical. I will say that existing managers have a leg up over newer relationships just because we know them well, and I think, in the fairness of partnership, they have a leg up. We're going to take a deep look at them regardless of how they're performing.
The existing managers, what percentage, just roughly, do we re-up on our next fund? Is it a high percentage? So we got a manager in fund in 1 and 2 and we've been with them. Is it highly likely we'd be in fund 3 then?
It's a relative look. We'll say we have a general preference for long-term partnerships. We're going into it thinking that we are going to commit to multiple funds. We're not chasing returns because this manager did well, and this quarter, this year, we're looking for managers that we can partner with for multiple funds. So there's certainly a preference. I will say in the last couple of years, there's been some churn of our existing names. And that's really a focus to figure out who our highest conviction managers are and who we want to partner with. So it's less is more going forward. So there's been some churn, so it's been higher than expected. I think it will subside over the next year or two. Moving forward for the year, we're looking to increase allocation to credit strategies and Asia exposure. That's a continuation of what we've been indicating over the last couple of years. So last year, based on commitments, 37% of commitments were credit or debt-focused strategies. That's certainly a shift from the historical portfolio, where debt was maybe 10% of the portfolio. I think we're doing this in light of the market environment, one part, because things are expensive on the equity side. So I think we're taking a more conservative, downside-focused lens of things. But additionally, because we think it's an interesting asset class, private credit, that is. Cash flow for the quarter was a negative $52 million. That number alone is not that meaningful, but I will indicate that the portfolio has shifted in more of a growth of the portfolio, and so there will be greater contributions moving forward. Our distribution levels have remained fairly consistent, so the portfolio has been performing well, but we're also growing the portfolio. So it will be a net outflow for the coming quarters and years as we ramp up the portfolio.
It's now, help me. Joe, it's in your...
Yeah, growth, you mean in terms of the growth of the asset class?
Right, it's now 31.
Oh, you're looking for the actual percentage on page?
Right, 11.97.
8, yeah.
And growth to what percent?
Well, I think to Michael's comment on growth, if you look at page 9, right, the actual asset class has grown year over year as a larger percentage of cap. So the only way it can grow is if we're putting more dollars in than we're taking out. And so that ties to this negative cash flow, right? We're investing more dollars today than taking out, because that's how we get private equity to be a increased percentage of overall cap.
One more time.
Okay. So the intention over time is to diversify across asset classes. What we're doing is taking some dollars out of US equity, putting them into private equity.
Correct.
As those dollars go into private equity, we're putting them either more dollars in with existing managers or more dollars with new managers, but those dollars, new dollars going into private equity are going out the door to managers. That's part of this negative cash flow.
Right, I understand that.
So the negative cash flow, you might say, oh, negative, that sounds
No, I
bad,
understand
but
the
we
negative
need
cash
negative
flow.
to grow.
I just wondered if we're about 12% of cap,
Yeah.
right? I mean, are we looking to go to 13 or 14 or is that not a?
Simple answer is yes, partly because we'll continue to put some dollars in there, but also because we hope private equity is the top performing asset class and therefore kind of grows because of its returns, not just because we put more dollars in it.
Right, thank you.
And for context on what that means, I think over the last year or two, you've probably seen commitment sizes increasing compared to historical, for those that have been here longer. And you probably haven't seen the impact of that. But last year, we put 365 billion commitments to these managers. And that is high compared to historical commitment levels from the previous 5 years, which was more around the 200 range, a little under that. So it has been a strategic shift in the PE portfolio to contribute more. Thank you all.
Okay. Ethan?
Mr. Chairman.
Hi.
Members of the board, good afternoon. I am on page 24, and I'll be taking you through real estate and natural resources. The general story with real estate, if you think about the economy as a whole, it's generally healthy. Jobs are, the unemployment rate is healthy. Consumer seems relatively strong. Spending, all that's pretty positive for real estate. I'd say overall, operating fundamentals are pretty stable. Rents have certainly been decelerating, but are still growing at a positive rate. Vacancies are holding in there. Transaction volumes have remained strong and high, both on a global and domestic basis. Cap rates, pricing for the overall real estate market is holding in there just fine. What that generally will indicate is while prices have remained stable, you can expect that income will be a larger percentage of the return on a go-forward basis. NOI, the growth, the rents seems to be growing, seems to be outpacing inflation, generally speaking, so that's a good thing for fundamentals and values. The secondary markets seem to be attracting more capital than the tier 1 markets, the gateway cities. Yields or cap rates tend to be higher there, and there's a real search for yield in the market going on. So that remains strong. And then again, dry powder and the fundraising market are quite healthy. People are still allocating to the asset class. People are still raising money successfully. And I've outlined the key takeaways there at the bottom for you.
So, and then dry powder is money that real estate investors have raised that they haven't spent?
That's correct. Yep. Any other questions? Okay, we'll flip to page 25, where we'll take a look at performance. I'm not going to walk you through the numbers, they speak for themselves. Happy to address any questions, otherwise we can just flip to page 26, where we look at sort of characteristics and what's gone on over the last quarter. You know, we have our net asset value here of just shy of 900 million. Again, as a reminder for everyone, and maybe not a refresher for you, Bruce. It's a highly North American-centric portfolio. It's very well diversified across property types. Of late, we've been focusing more on an operator model than an allocator model, and to explain that, differentiate it for you. Allocators are folks that will go out and raise big pools of equity capital, and then they'll find operators, joint venture partners in local markets where they will provide anywhere from 98 to 90%-ish of the equity for a deal. The local operator will provide the remainder, and they'll sort of have the day-to-day operational responsibility, boots on the ground at the property itself. The allocator will still own capital allocation decisions, leasing decisions, will manage the annual budgeting process. But they're primarily major decisions in equity versus an operator who is boots on the ground. They're vertically integrated. They'll run the whole process from acquisition to disposition, manage all the financing, leasing, property management, asset management decisions, construction, etc. And they have all those folks on staff. And why, you might ask, have we focused a little bit more on that? We just feel that they're closer to the asset. They, because they have the staff that they do, we feel they can make decisions more expediently. They're closer to the data, and they're just in a better position to manage the asset day to day. It's not to say we're entirely moving away from the allocator model. I think there's an argument to be made. I could take that a little bit further. Typically, part of the upside of a deal is in an allocator model. Part of the upside of the deal on the ground is actually shared with the operator, so that drags on the overall return to the fund. So that's part of the argument too, to shift away from allocators to operators. But nevertheless, there will always be a little bit of a mix, and so I don't want to set your expectations that we're moving entirely one way or the other, pardon me. But just a little bit more of a focus. Property type specialists, people that traffic in multifamily or medical office day in and day out. The empirical data typically bears out that those folks will outperform generalist models and allocators. So pardon the tangential description, but I thought that was important to highlight for you. So moving forward, again, these asset classes contemplate a framework of public, private, equity, and debt. So anticipate as we continue to build the portfolio, we'll be looking at and anticipate adding direct lending strategies in real estate, a publicly traded REIT mandate. We have had folks in just recently. Thomas did a deep dive and looked at a number of managers. We narrowed it down to 3. We had them in here as recently as last week, and we'll be making a decision there within probably the next 30 to 45 days, would be my guess. So hopefully something we can talk about at the next board meeting. Negative cash flow for the quarter, that was primarily driven by what you see below. We topped off our commitment to HART, which is a core open-ended fund. That was a cash flow of $70 million, and then we added to our Fidelity high yield CMBS strategy, which is a cash flow of $30 million, so that's what's primarily driving the negative cash flow there. The leverage is there for you. Everything, I'll just tell you, is well within our defined constraints within the investment policy statement. If there are no questions, we can flip to natural resources.
Questions on real estate?
Cash flow as a positive, negative? Is that what that is?
Oh, you know what? Good
Tell me what
catch.
it is.
So I caught that. That's funny. I caught that. I was going to bring that up on page 32 because I had the same typo in energy. So it is negative. It is a negative number.
Positive, negative, which is a negative.
It's positively negative.
So my my apologies there.
Plus or minus is a minus.
That makes more sense to me.
The same thing is true with energy. It's a negative 5.3 million. The number shows properly, just missed the negative to positive switch, and I apologize. That shouldn't happen, so that's on me.
Always makes me nervous when I don't think I
Yeah.
got something.
But you're literally sound.
Gosh, you look at these things thousands of times and your eyes glaze over sometimes. So anyhow, a little bit more attention to detail next quarter. Apologies. Shall we move to natural resources?
Okay.
Okay, so I think I started with timber here. Pacific Northwest lumber, timber prices were down a little bit. Flow has been a little bit disrupted just given the trade talks and some uncertainty there. The southern part of the U.S. Was already saddled with quite a bit of oversupply, and then got a double whammy when Michael came through and really crushed the U.S. South. I think it was one of the largest hurricane category 4 to make landfall there ever, perhaps, certainly in the last 50 years or so. Damaged infrastructure, not only roads to get and access the actual timber, but mills were shut down for months on end. And we'll get to that in just a minute because it has a direct impact on our portfolio that I'll highlight here in just a minute. Returns are here. The fourth quarter returns weren't out when this was due. I'm happy to give them to you if you're interested. I should probably just have that off the top of my head, and I don't, but they were positive for the fourth quarter. The specifics are close at hand. The index was up 1% in the fourth quarter. So muted returns, but still positive. By all accounts, construction activity for the year seems to be holding steady. Multifamily construction remains strong. Single family has been slow and down. Starts, lots of things contributing to that. Largely affordability seems to be one of the big drivers there. Millennials saddled with student debt, starting families at a later date, that sort of thing. And again, I put the key takeaways here for you to focus in on. Maybe as it relates to timber, so we have about a $23 million position with RMS Forest Growth 3. That fund itself has a net asset value as of 9/30 of $147 million. 23 million of that is exposed to a property called Weewahitchka, which is right on the panhandle of Florida, right outside of Mexico City Beach, which was ground zero of Michael. This is a technical term, but according to the insurers, Weewahitchka, by the way, Weewahitchka is a timber deed, so we don't actually own title to the land. We just own the right through this fund to harvest the timber. It received catastrophic damage. It is likely that we may not receive any ongoing value from that investment. They are still working through the final appraisal of that particular property. The property did have $20 million of catastrophic insurance on it. The details of that are still being worked through. We, as the Board of Investment, have a 16.06% position in Forest Growth 3, the fund in its entirety. And the Weewahitchka property itself is about a 16.06% of the fund. When you do the math, the overall position of Weewahitchka that we have exposure to is about $3.6 million. To put that in context, that's about 3.2% of our overall timber portfolio. It's just north of 1% of our natural resources portfolio, and it's a grand total of 0.03% of CAC. So as we break it down, it gets more and more diminished and is really, frankly, speaks to why we have such a diversified portfolio and how, while catastrophic, and it will certainly have a severe impact on go-forward expectations at the individual RMS Forest Growth 3 level, it is likely to have very little impact on the overall fund. It is my duty to continue to keep you guys apprised of this as more information becomes available to us, but that is that's the situation today as I know it.
Ethan, what did you say we were invested in it? Did you say 20 million?
Yeah, our specific capital, $22.97 million was our capital count as of 9/30.
In the whole fund,
That's correct.
16% of which is this
Yes.
property.
16% of the fund, we have 16% of the property, which equates to 3.6 million of that 22.97 million.
And that was to buy the timber rights? That money went out to buy the timber rights?
It's called a timber deed. You
Or
typically
timber deed,
own timber either fee simple, where you own title to the property, you actually
Right.
own the land, or a timber deed, which just gives you the right to harvest.
Right, but my question is that 3 point whatever million,
Yes,
that went out to purchase the timber deed?
yes, that's the remaining value of our right to harvest the timber on that timber deed as of 9/30.
Right.
Yes. And
So no more would go out?
no, the fund is completely drawn down. That's right. It's been drawn down for a number of years now. We have
Okay.
our full $25 million commitment. Well, it's just shy of that, but I think $435,000 was ultimately sort of forgiven as out of our.
And in a, I don't know this, but in a southern forest catastrophic hurricane event, is there no salvage?
So so it's a good point. Because of the damage to the infrastructure and trees laying sideways, roads being destroyed, washed out, it is likely that they're expecting very little salvage value before the timber gets to a point where it's beyond salvage, it's rotted essentially, or the bugs have infested it and it's got no value. There may be some pulp value, some perhaps low-grade chip and saw. I think that's probably why the overall value will not go to zero in this particular investment, but they're trying to manage our expectations as well.
The $20 million insurance plan,
Yes.
and I lost track of the numbers, but is the 3.2 exposure after crediting a portion of that insurance?
Not yet, no.
So what percentage would that be of the total loss? I mean, what could we look for in a percentage reduction if we got the $20 million insurance claim? 16.6%?
I'm not sure how to answer that question. Maybe I just don't
Well, I'm
understand the
saying we
question.
got a potential $3.2 million loss.
Yeah, 3 points.
And the insurance money is $20 million.
Right.
And does 16.6% of that come off the $3.2 million?
So yeah, I guess it would be, if I think about, we own 16% of that overall insurance policy, so yes, that would be applied to the remaining value. So it might be, I guess I think where you're going is it could be almost a wash. If it's written down to zero, but we get the insurance claim of approximately, $3.2 million, it could be.
Yeah, I'm thinking maybe that would net out.
Yeah, it might.
Okay.
But TBD, but I'll certainly keep you all posted. Okay. If no more questions, we'll move on to the oil markets. Again, it's kind of sluggish activity in the capital markets as it relates to energy overall. If any of you have been following OPEC and those talks, Russia and Saudi Arabia agreed to cut their production by $1.2 billion barrels per day. As with many of the asset classes, oil got pretty well crushed towards the end of the year, throughout the year. It has since rebounded pretty significantly. It's not back up at its levels of early 18, but I think as of yesterday's close, Brent was at 61.42 and crude or WTI closed I think at 43.42. So back up pretty nicely. The U.S. has surpassed Russia and Saudi Arabia as the world's largest producer. It is now a net exporter of oil. Demand remains, expectations, growth in demand is expected to continue. The MLPs, much like you may recall, we added a position to a publicly traded MLP. They got crushed towards the year end. They have since bounced back, and as I'll talk about here, I'll just talk about now, we actually added some dollars to our MLP strategy and almost hit the bottom perfectly, but not quite. But I think it was a good move, and the portfolio will benefit from that. Fundraising was strong, continues to be strong. There's dry powder out there in the market, and the key takeaways are highlighted down at the bottom for you. Happy to address any questions.
I don't know what MLP.
Pardon me, it's Master Limited Partnership. Page 29 is performance. Again, it's I won't read you the numbers, it speaks for itself. Large part of this is just due to the public market sell-off. As it relates to natural resources, $314 million of net asset values, spread $200 million between energy, $113 million between to timber. They're diversified portfolios, energy across the value chain, timber across geographies, species, age classes. You can expect us to continue to look at differentiated strategies within the natural resources portfolio, be that direct lending, other operators that have more of a PDP focus, which is proven, developed, and producing, so more cash flow oriented, less upstream wildcat exploration risk, if you will, and just other types of natural resource oriented strategies broadly. We did have a negative quarter as far as cash flow for energy. Apologize again for the typo there. Timber was a positive cash flow on the other side, and then as mentioned, we added $25 million to Chickasaw not too long ago, and the leverage for timber is there at 5.7%, well within the 0 to 30% range constraint.
Okay,
Questions?
questions? Thank you again.
Appreciate it.
John?
Okay, I'm on slide 31 for internally managed fixed income. The U.S. Treasury curve flattened over the course of the last year. I've been saying that for a long time, but it keeps getting flatter, and RBK stole most of my thunder on the inverted yield curve, so I won't go over that again because I did a good job going through what that looks like and why. Would agree with them that there's a little bit of a disconnect in the market at the moment between what the market thinks and what the Federal Reserve has thus far signaled for expectations for further hikes this year, but I think there's some expectation that perhaps they soften that stance going forward, although very data dependent. One of those strong pieces of data would be inflation. So noted here that headline inflation fell a little bit in December below 2%. We got inflation numbers today for the January time frame, and it fell further in terms of headline inflation, but that's really related to what Ethan was talking about with energy. So energy prices dropped significantly in the fourth quarter. So if we look at core inflation, which is really what the Fed tends to pay a little bit more attention to, that stayed flat at 2.2%. So core inflation is stripping out food and energy, which tends to be quite a bit more volatile. So from that standpoint, not a lot necessarily to suggest that the Fed would change course at this point. We'll see. Spread product. So when I say spread product, that's anything that's other than treasuries where we would expect to earn a spread over and above treasuries or a greater yield or return. Spread product widened across the board. You can kind of see the notes there. The standout is certainly in the corporate space where we saw a very significant widening in the fourth quarter. But subsequently, we've seen a pretty good snapback in the first quarter as well. Moving on to slide 32, intermediate treasuries, best performers over the course of the year, and intermediate tips were the worst. That was the exact reverse last quarter. So speaks to our quarterly swings that we're not necessarily paying a huge amount of attention to. Try to remain longer term focused. Bond market liquidity has remained good throughout the course of the year, pretty strong, no trouble moving bonds back and forth when we needed to. Corporate issuance has also been strong, a little bit down from the last few years, but I think last year was, still like the third strongest year we've had. So lots of new debt still being issued. Federal Reserve continues to reduce their balance sheet. We've talked about that a little bit before, and it became more of a focus in the fourth quarter as people started to think about the ways that the Fed is removing stimulus from the market, particularly the mix of what they might have on their balance sheet. We've talked before about how they've got mortgages and treasuries. They've made some comments or indications that I think they would rather hold treasuries on the balance sheet and get rid of the mortgage piece. So that has weighed on mortgages as we kind of had expected that it would. Questions on the fixed income environment? Seeing none. Going to slide 33, I won't spend a lot of time here either on performance other than to say within the next few slides where we're looking at this, I noticed that the scale is a little bit off, I think, on some of these, but the numbers on top of each of the bars are accurate, so you can pay attention to that. We'll clean that up next go around a little bit. So 34, looking at the Treasury Agency portfolio, doing good positive performance for the year. Ended up kind of flat to the benchmark. We reduced the portfolio by about $25 million in December. We moved that money into the corporate portfolio as we had a big spread widening event, and we looked to take advantage of that a little bit and add to the corporate portfolio. Duration theme across most of our portfolio has been a little bit shorter than the benchmark. That has generally been a function of the fact that it's a very flat yield curve. We are not necessarily getting paid to go out a lot, so we've been somewhat cautious there. And again, for maybe newer members, duration is a measure of the sensitivity of the portfolio to a change in interest rates. I won't go into more detail than that because it seems to be a confusing subject, but we can talk about it offline at any time if you want. Always here.
3 days.
Huh?
3 days.
I'll let Kirsten and John explain it to you later. Our spread product categories within this bucket, agency CMBS and agency securities, we're pretty close to the same levels that we were at the end of the quarter as the beginning, although we did add a little bit to that probably as we entered the first quarter here. Questions on that portfolio? All right, moving on to tips, I'm going to just skip over the performance slide there, but slightly negative performance overall for the fourth quarter, or for the year, I should say, although we did modestly outperform the benchmark. As I've talked about before, we don't tend to take real active positioning here. We tend to realign this portfolio to the benchmark about once a month. Not that we can't take an active bet, but we just haven't at this point. Added about $50 million here in October. I think most of that funding came from probably a reduction in domestic equities, as Joe's talked about before. But I guess the significant thing here is in conjunction with the other issues we had in the fourth quarter, we'd seen break-even inflation. So again, inflation, we'd be indifferent to whether we own nominal treasuries or tips, which are benchmarked to inflation. That went against us strongly in the fourth quarter. So inflation expectations within the market fell, along with the rest of the economic expectations being much worse in the fourth quarter as well. So that went against us. Questions on the tips portfolio? All right, moving to mortgages. So, positive return in the mortgage portfolio. We've talked about for a number of quarters how we were kind of cautious about the mortgage market overall throughout the course of the year. That paid off for us pretty well as certain segments of the market did get hit pretty hard given the volatility that we had during the year, and spreads widened modestly throughout the year. So pretty good outperformance relative to our benchmark here. We significantly overweight the 20-year mortgages as opposed to the underweight the 30s. That's been a pretty steady position for us over the course of the year, and probably even further out, near the bottom of the range in asset backs, and no big change in our non-agency CMBS exposure there. Questions on the mortgage portfolio? All right. Investment grade credit. So slightly negative return here, again driven by wider spreads. We saw corporate spreads throughout the course of the year. We were about 9 bips wider through the third quarter, and we moved out 42 bips just in the fourth quarter alone, so a pretty big move. Almost all of our outperformance relative to the benchmark was what we garnered in the fourth quarter. We talked for a while about being kind of up in quality in corporates because we didn't think we were getting paid there a whole lot, and that certainly benefited us. That outperformance was probably as much about what we didn't own as to what we did. So think of names like General Electric that got hammered in the fourth quarter and probably a little bit before. PG&E, the utility company in California with all the fires, and they went from investment grade to bankrupt basically in a very short period of time. We've owned both of those names in the past. We didn't own any of them in the portfolios at this point in time. So, as I said, we added $25 million to the portfolio in December. Tried to take advantage of wider spreads. Spreads have widened both because economic expectations had changed, but also because there were a lot of technicals in the market at the end of the year. There's always a slowdown in the bond market as we approach the holiday season. So we did that $25 million. We were able to put it to work over the course of December. That worked well for us. Probably would have done more had we been able to, but it's a difficult time to get things done. So I was happy with what we were able to do there. Again, a little bit underweight duration, a little underweight the longer end of the curve, overweight financials and underweight industrials. That hasn't changed markedly from where it was. Especially underweight, kind of a lower end of the spectrum, the BBB-. Questions on corporates? All right.
Okay. Randy?
Mr. Chair, on page 41, broad fixed income. Broad fixed income is made up of the Reams portfolio only at this point. Reams had a very good quarter and a very good year. As markets got nervous in the fixed income markets, as we talked about. We've been talking several quarters about how Reams have been defensively positioned by being overweight treasuries and underweight corporate credit and MBS, and it paid off in the correction that we saw in the fixed income markets that accompanied the equity correction. And on top of that, there's security selection within corporates also did very well because they've been in the higher quality issues. So good for them. I mean, we've been sitting here, I think probably for 2 years I've been telling you guys they've been defensively positioned and therefore they've been lagging a little bit. Well, it was their time and they came through for us. So good for them. Any questions on broad fixed income?
It's what you expected, right?
Yes. High yield, talked a little bit about that earlier in the meeting. Yield spreads for high yield go out to over 500 basis points, which is the first time we've seen that in over 2 years. The defensive nature of the composition of our managers and managers individually showed its mettle there. 3 of our 4 managers in high yield outperformed during the quarter. The one that did not did so more because of security-specific issues rather than the way they were positioned. So all in all, the way that our managers performed and the way that the asset class performed during a period where downside protection should work. They met our expectations to a large degree. Our conversations with them, and in fact, I talked not only with our fixed income people, but all of our equity people this time around, particularly the managers that are expected to do better so in down markets. I asked them, each individually, including our high yield guys, how they felt about how they did. And largely across the board it was, well, they felt they could have done better, but the guys that were protecting the downside in high yield did add value for us to the downside. So that was good. Any questions on high yield? Domestic equities. You kind of beat this asset class to death here. But needless to say, big correction in the fourth quarter, big sell-off and a big comeback here so far this quarter. Down 124 basis points on a relative basis in the quarter. The asset class has actually made up almost all of that in this quarter, which shows, as we're talking about long term, it shows not to get too excited about one quarter or another, because we're just about even from where we were from a relative performance standpoint in the fourth quarter. Again, cyclical stocks and small cap stocks did the worst, so there was some contraction in performance by the small caps, but actually our small cap weighting is not as great versus the benchmark as you would think. And in the interest of time here, really quickly, if you look back at page appendix, it's 15.75%, I believe, that's domestic or international, 16.8 in benchmarks, around 15. So slight overweight there in small caps that did detract, but mostly what detracted in the quarter was the performance of our managers. And like I said earlier, I asked each one of our managers how they felt the quarter went, and it went, their assessment of the quarter was exactly what our assessment of the quarter had been, which was we did expect more downside protection, but this isn't a perfect science. I mean, over time, over the long term, that should happen, but there are a lot of things that happened in the quarter that were pretty messy, and our managers alluded to them as well. So they were, our managers either outperformed slightly or underperformed that we expected to do better for us in such a market. When you have a sell-off like that, I mean, there's especially a panic sell-off, as Joe described it, in the markets. There's just indiscriminate selling. So to take one quarter and say, gee, did this manager, outperform on the downside like they should have, it's really tough to do. Because there was just, I mean, people were just, throwing whatever stock there was, out there and shooting it. So that makes it really tough to outperform and to assess for a quarter. And then also, our managers that we would expect over the long term to be downside protectors, largely, and this is a market phenomenon, largely are not. They're in utilities and REITs and some of the other higher defensive and higher yielding areas. And the reason they aren't is because those areas they consider to be more highly valued, they're expensive versus some of the others. So what we have going on is some of these managers are in more cyclical stocks rather than, say, the utilities or the staple stocks. And when you have a sell-off like we did, the cyclicals did worse than the staples and the defensive stocks like the utilities. So that's why a lot of our downside protecting managers did not do as well in the quarter as what they had anticipated and what we had anticipated. But again, like I said, this is a long-term process, and we still would expect that over time these guys would come through for us over a number of periods of time in those kind of scenarios. So I mean, the one good thing about the correction is it made equities more attractive from a valuation standpoint. And so one thing that that's one thing actually we don't run a lot of cash within the asset class, as I mentioned yesterday, because Joe likes to take it out of there if we don't want to use it for equities. But what cash we did have in in domestic equities at asset class level, I put to work a few days after Christmas, and it worked out pretty well for us in January and February to date. So pretty good timing on our part there. As far as performance on our managers, nothing specific really to point out. Just generally, we still believe in our managers as a whole. We think we have good managers for the long term, and active management industry-wide had another difficult quarter, and it seems like I've been talking about that for several quarters as well. So again, I think the best combination of this asset class, or international equities for that matter, is to have a combination of passive and active portfolios. Ken and I both agree on that, and so, like I said, still believe in active management and the managers that we have to some degree here. And
how about Iridian? They seem to be.
We still believe in them to this point. Yeah, if we didn't, they'd be gone. But Iridian is one of those managers where they have high tracking error. They have a lot of stocks that aren't specifically in their benchmark, and so they can do really well given a short period of time, or they can do very poorly, and they're on the downside of that right now with doing not very well for us from a performance standpoint. But if you recall, when we hired them just a few years ago, they were the #1 performing manager in the universe of managers there for that first year because they did so well. So it's one of those portfolios that is just going to be up or down to a greater degree than the others within our stable of managers. So we're hanging with them. Okay, any more questions on domestics? Okay, we'll move to international. Not a whole lot to say on international. I think we talked quite a bit about it yesterday as it is. Same response in the markets in international where the market sold off due to economic concerns and the Fed being asleep at the wheel. And the markets came down significantly and underperformed versus the U.S. markets, and which helped our performance and our asset allocation. Small caps did the worst in international as well, so that hurt us a bit in the quarter. Interesting thing is that emerging markets didn't sell off as much as small cap stocks did, and sold off about what the developed market large caps did, which you would have expected emerging markets to sell off much more. So not really sure what went on there. I guess if I had to take a guess, I'd say that the investors in EM, maybe they were figuring that those stocks didn't have the liquidity that some of the others did and developed large caps and developed small caps, and so they sold those instead as they were heading to the sidelines. So again, the bright spot at the end of the quarter was that valuations looked pretty good. We didn't feel a recession was coming anytime soon within the next year, and because the valuations were attractive, I did put what cash we had to work in this pool at the asset class level as well to work the last few days of December and the first couple of days of January. And again, did pretty well as far as not that we want to time markets, but I just kind of said, I think this is ridiculous. It's time to buy stocks, and so I did. So we're pretty well. I'm a stock guy, you know that. We mentioned performance.
And that works? This is ridiculous, I'm buying. No, I meant the pitch. The pitch works. This is ridiculous, I'm buying. That works.
Yeah, this time it did. Anyway.
Yeah.
Page 57. We said we'd mention something about the performance today, and so there's our active managers for 1 and 3 years there. Acadian's done really well for us, as you can see. The others have about a little over a 3-year tenure with us now, most of them, because we restructured the pool and replaced the managers there that we were having difficulty with. Acadian, I think, is a really good example of what we try and do here. They struggled, as most of the quantitative managers did back in 08, 09, with that inflection in the markets. And when we looked at, and Cliff and I looked at reducing our exposure overall to quantitative managers, we felt we had too much. We went through the managers, and this is one manager that we started to stick with because we really thought they were a good group and were a quality manager. And so we stuck with them even though they were way behind the benchmark way back then. And we were just looking the other day after the review again that every single calendar year since the GFC, Acadian has outperformed their benchmark. It's just like boom, 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 boom. So, I mean, they've really been consistent in coming back for us, digging themselves out of the hole and now actually adding value over time versus the benchmark. So a good example of sticking with a manager when you feel that, you know, their style's out of favor, but they're still a quality organization that they can do well for the long term. And I think that's about it. I mentioned we put cash to work at the end of December, early January, and that's about it. Okay.
Questions? Thank you.
Okay, thanks.
Okay. Kristen feels like she already knocked it out of the park this morning with STIP, so unless you have other questions, we can skip over that. Great. All right. Jack's okay with that.
Skip lunchtime.
I know. Getting that. State fund, very quickly, so, you know, similar theme to everybody else here, got hit pretty hard with their equity portion of the portfolio, which really dragged down their returns for the year, but outside of that, you know, did okay, helped a little bit by their real estate exposure. Overall, the bond portfolio, Joe and I actually just went over there a week or so ago, and as I told them, you know, okay, we underperformed the benchmark by a few bips here, but actually that was much better than I would have expected, given the large overweight that they have to corporate bonds. So I'm actually pretty pleased with the downside protection there. Aside from that, core real estate went up a little bit during the quarter, but that was really kind of a timing issue. Had a manager that drew down some funds from us, but we've been getting money back, as you recall, from some of the other managers, so that will kind of balance out over the course of the next quarter. So, questions on state fund? Okay. Moving to trust fund very quickly. John said I could do this one as well. Didn't want to come back up again, I don't know. Good returns here overall for over the course of the year. You know, no real change in strategy or anything here to point out. Similar positioning to other portfolios, a little underweight duration. Got beat up a little bit on credit, but, and high yield over the course of the fourth quarter, but overall performance is within expectations. Nothing really new to report there in particular.
Okay, questions? All right. So, I think we're done. Do we have any to-dos?
Follow-up RFP for consulting services, we'll get into those details in April. And then, as of yesterday, it was unclear whether or not your confirmations would be segregated from the remainder of the Department of Commerce confirmation resolution, but I will be in contact with each of you individually as to how that will proceed.
Okay.
So do you have a time frame when that would happen
It has to be relatively soon. I anticipate a hearing and a vote before the next meeting, which is April 2nd.
Do you think we would testify?
Depends on whether or not you're segregated. If you're segregated, then you'll have to come up for the hearings at the State Administration Committee of the Senate. If you're not segregated, most likely not.
Yes.
You were going to get that email of the request for the trial.
Anything else on the to-do list?
That is it, Mr. Chairman.
Anything else anybody else remember? If not, we'll see you See you all on April 2nd.
Mr. Caretaker, okay, we're running.
Are we running?
I'll turn this down.
All right, we're up and at 'em. And we'll call the meeting to order. It's February 13th at 8:30, and we are on the second day of our meeting here, and we'll begin with a roll call.
Carl England.
Here.
Mark Nonick.
Mark said he'll be a couple minutes late.
Jack Prothrow.
Here.
Terry Cogy. Bruce Nelson.
Here.
Diane Fladmo. Yep. Maggie Peterson. Jeff Greenfield.
Here.
Jim Edwards. Senator Sales. And Representative Hamilton.
So I know Jim Edwards is dealing with some family health issues, so hopefully we'll see him. Representative Hamilton said he'd be here when he could. He's dealing with health issues. And I'm sure we'll get Diane on the line. But we are recording, so people remember that. Public comment.
Yes, Bev Rivas.
Good morning.
Good morning.
My name is Roxana Aslin. I'm with Unite Care Local 11. I would like to update you on the labor disputes at two hotels, the Irvine Marriott and the Pullman San Francisco Bay, both of which are owned by CBRE Global Investors Strategic Partners Fund 7, and together account for more than 20% of the value of Fund 7. As a reminder, the Board of Investments is a limited partner in this fund and others managed by CBRE. Thank you to members of the board and staff for the attention you have given to this matter. Unfortunately, CBRE has failed to resolve the dispute. On January 8th, workers at the CBRE-owned Irvine Marriott Hotel voted in a National Labor Relations Board election to unionize with Unite Here Local 11. The workers won in spite of an aggressive anti-union campaign waged by CBRE's operator Marriott. As Xander will soon tell you, the hotel interrogated and threatened workers. Local 11 has filed 9 unfair labor practice charges with the NLRB, alleging these and other actions violated federal labor law. A regional office of the NLRB is currently investigating the charges. On January 28th, Irvine Marriott housekeeper Leticia Vallejo filed suit against the hotel's operator in California Supreme Court, alleging that her supervisors at the hotel didn't do enough to protect her from guest misconduct, creating a hostile work environment. I've provided the board with Vallejo's interview with Bloomberg. Vallejo and her co-workers at the newly unionized Irvine Marriott Hotel will soon begin bargaining for a union contract and will demand panic buttons, procedures to ban guests that harass workers, other protections against sexual harassment, as well as wages and benefits that will enable them to provide for their families. To make matters worse, as you will hear again from Isabel from CBRE's Pullman San Francisco Bay Hotel, Pullman management has refused to stay neutral in response to worker organizing. After Pullman workers started picketing, the hotel brought in regional management to hold department meetings where employees were told that they could lose hours because of their actions, and that workers didn't need a union to represent them. Pullman workers continue to request a labor peace agreement from Pullman operator HEI that would provide a fair, neutral process for deciding whether or not to form a union. Our experience with the anti-union campaign by CBRE's manager at the Irvine Marriott only reinforces our conviction that Pullman workers need a substantive commitment of neutrality from both the owner and operator of the hotel. It is not in the interest of limited partners to sell the Pullman and the Irvine Marriott when conditions like these prevail. CBRE had been marketing both hotels for sale, but on January 28th, the Pullman Hotel's general manager announced in a general meeting that the hotel is no longer for sale. The general manager earlier told workers that 7 buyers toured the hotel and none of them had come back. He said that no candidates had come to see the hotel in the last 2 months and that the asking price was too high. The labor dispute at the Pullman Hotel continues. The common denominator at the Irvine Marriott and the Pullman San Francisco Bay is CBRE. These disputes are not in the best economic interest of the many Montana beneficiaries that the board serves. We have provided you with a draft letter that the board could send to CBRE asking them to urge Marriott to settle a fair contract at the Irvine Marriott and to obtain HEI's signature on the labor peace agreement that CBRE has already signed at the Pullman. The board should decline to invest in any subsequent CBRE funds until the firm has resolved the disputes at both hotels. Thank you.
Thank you.
Oh, and now you will hear from Xander from the Irvine Marriott.
Hi everyone. My name is Xander Salas. I have worked for the Irvine Company Marriott as a line cook for 5 years. I have actively participated in organizing the union with my co-workers at the hotel since November 2018. On Wednesday, December 12th, we decided to file for an NLRB election. The election happened on Tuesday, January 8th, and thank God we won. I have come here to tell you everything we went through in our difficult fight to win the union through an election. Since the moment we filed for an election, the company has been anything but neutral. Marriott ran a dirty anti-union campaign. There was nothing fair or democratic about the election process. They tried to divide us, scare us, buy us, and lie to us about the union. They threatened that we would lose our benefits. I don't want my brothers and sisters at the Pullman to have to go through the terrible campaign that we went through. I was part of the group that first approached management asking for a fair process to decide on unionization on November 15, 2018. Immediately after that, the executive chef, Adrian Hernandez, held a meeting with all the cooks and dishwashers that were working that day. I was not present, but according to workers who were there, Adrian told them he felt betrayed by what we were doing. Later, the union filed unfair labor practices charges, alleging that these and other statements Chef Hernandez made violated federal labor law. The National Labor Relations Board is currently investigating these charges. In addition, David Marriott, a vice president of Marriott, came to the hotel and told us in a big meeting with housekeepers and cooks that he wanted us to vote no for the union because we were a family and we did not need the union. This statement made me feel even more confused, and I thought I was hurting the company and started to have doubts on my decisions to organize the union. The company sent 5 other people from corporate to convince us to vote no for the union. They will come to the kitchen and have meetings there with the cooks and dishwashers. The sous chef, Nancy, tried to pull me into anti-union meeting, but I told Nancy that I would not attend this meeting. I felt these people were harassing us because they would show up at any time and would say the same things. One thing I remember them saying is that if we won the union, we would not be able to work in other hotels. That just did not make sense to me. That's when I saw the company had a strategy to fool us into not voting for the union. I felt even more disrespected. What kept me motivated month after month, day in and day out, was my powerful desire to make the Irvine Marriott a free, safe, dignified place to work. And now that we won, I am working with my coworkers to make that happen. Now, and I'm asking you to tell CBRE to get my hotel to settle a fair contract immediately. At the Irvine Marriott, we said enough, but no one should have to go through that what we went through just to win the right to unionize. Our sisters and brothers at the Pullman Hotel should not have to go through that. Thank you.
Last one. And I'm Laurel Fish from Unite for Local 2. I'll be translating for Isabel.
Good morning.
Good morning. Buenos días. Mi nombre es Isabel Ponce. Voy a usar un intérprete para poder decirles todo lo que quiero decir.
So, good morning. My name is Isabel Ponce. I'm going to use an interpreter so that I can tell you everything that I need to share with you.
Primeramente quiero decirles por darnos la bienvenida cuando venimos en noviembre. Nunca había venido a Montana. Honestamente estaba un poco nerviosa. Muchas veces en mi vida diaria me siento invisible o descontada por el trabajo que hago o porque no hablo bien el inglés.
So firstly, I wanted to thank you all for welcoming us when we came back in November. I'd never been to Montana before, and honestly, I was a little bit nervous. Many times in my daily life, I feel invisible or discounted because of the work that I do or because I don't speak English well.
Pero me alegro mucho haber venido a Montana. Sentí que me escucharon y me tomaron en cuenta de una manera que no siempre sucede. Gracias.
But I was really happy that I ended up coming to Montana. I felt like I was listened to and taken seriously in a way that doesn't always happen. Thank you.
He sido housekeeping en Pullman Hotel de Redwood City, California, por 19 años. Si nunca ha limpiado cuartos, debe saber que es un trabajo agotador. Todos los días friego los baños, cambio de docenas de sábanas y fundas, e incluso me subo a la tina para cambiar las cortinas de la ducha. Yo y varias de mis compañeras de trabajo nos hemos caído porque ni siquiera tenemos tiempo para encontrar una escalera para alcanzar las cortinas.
I've been a housekeeper at the Pullman Hotel in Redwood City for the last 19 years. If you've never cleaned rooms before, you should know that it's exhausting work. Every day I scrub bathrooms and toilets. I change dozens of sheets and pillowcases, and I even have to get up on the edge of the bathtub sink to change the shower curtains. Me and several of my coworkers have slipped and fallen because we don't even have time to go get a step stool to be able to reach the curtains more easily.
Me he sacrificado para que mi familia tenga la estabilidad de un cheque regular. Como madre soltera, cuento con mi sueldo aún más en la forma en que hemos podido hacer una vida y estabilidad. Estoy muy orgullosa de mi hijo mayor, ya se va a graduar de administración de empresas, y mi hijo menor, está en segundo año de universidad. Quiero lo que todas las mamás quieren, poder decirle a mis hijos que las cosas van a estar bien, que si trabajan duro y van a la escuela pueden lograr lo que quieran.
I've sacrificed so that my family can have the stability of a regular paycheck. As a single mother, I count on my paycheck even more so. It's the only way that I've been able to make a life and stability for my family. I'm really proud that my oldest son is almost going to graduate in business administration, and my younger son is in his second year of college. I just want to be able to I just want what every mother wants, to be able to tell my children that things are going to be okay, that if they work hard and go to school, they'll be able to achieve what they want.
Pero todo lo que está sucediendo en el hotel pone en riesgo esas metas. Pusieron el hotel de venta en noviembre del 2018. El 28 de enero, el gerente general anunció a todos que el hotel ya no está en venta. Cuando el hotel se venderá un día y al siguiente lo quiten del mercado. No sé cómo planear mi vida. No sé si podré mantener mi trabajo de un día para otro.
But everything that's happening in the hotel puts those goals at risk. They put the hotel on the market back in November 2018. On the 28th of January, the general manager announced to everyone in the hotel that that the hotel was no longer for sale. When the hotel is going to be sold one day and is taken off the market the next, I don't know how to plan my life. I don't know if I'll be able to keep my job from one day to the next.
Es un alivio por ahora que nos digan que el hotel no está en venta, pero quién sabe qué pasa mañana.
It's a relief for now to know that the hotel isn't for sale, but who knows what's going to happen tomorrow.
Para mí es claro que no se puede confiar en CBRE y su gerente. La última vez que se vendió el hotel, 29 de mis compañeros perdieron su trabajo. Cuando CBRE compró el hotel, el seguro médico familiar subió a más de 700 al mes y la cobertura es tan mala que muchos de nosotros no vamos al médico. Cuando mis compañeros y yo fuimos a hablar con el gerente general sobre la unión, él descontó el dinero de nuestro cheque de pago. Nuestra única opción fue presentar demandas de robo de salario ante la Comisión Laboral de California, que aún está pendiente.
For me, it's clear that CBRE and its managers can't be trusted. The last time that the hotel was sold, 29 of my coworkers lost their jobs. When CBRE bought the hotel, the family medical insurance went up to $700 a month, and the coverage is so poor that many of us don't even go to the doctor. When my coworkers and I went to go talk to the general manager about the union, he took money out of our paycheck. He took the time out of our paychecks. Our only option was to present claims for wage theft before the California Labor Commission, which are still pending.
Lo peor de todo es que CBRE no ha podido garantizar que podamos organizarnos sin miedo a sufrir acoso o represalias. Firmaron el acuerdo que queríamos, un acuerdo de neutralidad, pero no pudieron conseguir que su operador HCI firmara el mismo acuerdo.
The worst part is that CBRE hasn't been able to guarantee that we'll be able to organize without suffering further harassment and retaliation. They signed an agreement that we wanted, a neutrality agreement, but they have not been able to get their operator, HEI, to sign the same agreement.
Serán 2 años en mayo desde que solicitamos a CBRE, su operador, un acuerdo de proceso justo. CBRE ha permitido que esta disputa laboral siga y siga. Me han arrastrado a mí y a mis compañeros de trabajo y también han arrastrado a los inversionistas del hotel.
It'll be 2 years in May since we asked CBRE and their operator for a fair process. But CBRE has let this dispute go on and on and on. They've dragged me and my coworkers through it, and they've also dragged hotel investors through it.
La única manera de resolver el disputo en Pullman es tener un compromiso por escrito de que CBRE y su compañía de gerencia se mantendrán neutrales. Sabemos que sin este compromiso los managers nos acosarán, amenazarán e intimidarán tal como lo hicieron en el Urban Marriott.
The only way to resolve this dispute is for Pullman, the only way to resolve the dispute in the Pullman is to have a written agreement that CBRE and their management company will stay neutral. We know that without this commitment, the managers will harass us, intimidate us, and threaten us, just like they did at the Irvine Marriott.
Para que yo, mi familia y mis compañeros de trabajo tengan una estabilidad real, necesitamos saber que nuestras vidas no se verán afectadas de un día para otro. Gracias.
So that for me, my family, and my coworkers to have real stability, we need to know that our lives won't be turned upside down from one day to the next. Thank you. Thank you. So we're here for questions if there are questions from the board.
Questions from the board? Thank you.
Thank you.
Any additional public comment? STIP Asset Class Treasurer Fund Review. John and we have 9.
Thank you, Mr. Chairman and members of the board.
at tab 9, but we're going to go a little out of order and do the treasurer's fund first, so that's the second.
Playing with fire here.
Hey, I should have said hey. Go out of order. So we're presenting the treasurer's fund for one reason, because it's a very large fund that we manage. Generally, 800 million to $1 billion, sometimes as much as 1.2 billion. And it has some interesting constraints around it. The fund is made up of monies from the general fund and other agencies that aren't otherwise allowed to keep their STIP earnings, or keep earnings from STIP. Focus in this fund, safety, liquidity, and then income. Allowable investments in this fund include STIP, and STIP is currently and likely to always be the large majority of assets there. But we are also able to invest in treasury and agency securities with a maximum maturity of 3 years. Other obligations that could end up in, or other investments that could end up in the treasurer's fund would be anything that came through the guarantee, through Resolution 219. The state code says that warrants could potentially be put there. And then occasionally the legislature will put some other things in code that could potentially end up in the treasurer's fund. I'd like to go ahead.
Why would we invest in treasury and agency securities separate from STIP because of the 3 years?
To increase the yield, assuming that there was a positively sloping yield curve, and assuming we felt that over the life of that security it would out-yield STIP, and that is why we would invest there.
What's the duration limitation of STIP?
No particular duration limitation, but the maturity limitation is 397 days for a fixed and 2 years for a floater.
Yes.
Yeah, question. Why do some state agencies get to be in STIP and others don't?
An excellent question that I would like to defer to.
The legislature has something
Had to do with
it?
some former budget directors.
He's in Cape Cod right now.
Former budget.
Couple of reasons. One, legislatively, sometimes there's limitations. They steer where the interest goes, so some accounts get to keep their own interest. Some accounts go to the general fund. Other times it's agency management, frankly. There's one particular agency who keeps a lot of money in STIP, despite the fact they have a lot of money in trust fund. They just choose to do it that way. No names mentioned on who that particular account holder is.
But there are agencies that aren't allowed, if they're not allowed to keep their interest, then they're automatically in the treasurer's.
Right.
And that's a statutory
Yes.
thing.
And I can think of one account that has a special revenue account, and so they don't necessarily keep it, but it goes into an account that they also manage that does not invest in STIP.
A lot of times with the HHS, they'll create a state special revenue account, funds will flow into it through a revenue source, and then any interest earned will go back off to the general fund.
So there's still earnings, but it doesn't necessarily go back to the agency.
Correct.
General fund.
Correct.
Thanks, John.
You bet. Thank you, sir. If I could refer you to
Set
slide
2, out of order, and Kirsten, are you sure you want to be up here with me?
If I could please refer you to slide 3. That graph there shows the month-end balances in the treasurer's fund. So a couple of things that I would point out is you can see significant seasonality in the more regular humps and bumps, but then you can also see some significant changes that aren't seasonal, and those are just reflect the general health of the state finances. And so what you might take from that is that there's a lot of variability from something in the neighborhood of 600 million or less to over 1.2 billion. And so before we decide to invest in longer term securities, we keep that in mind. A further constraint is that no more than 1/2 of the projected year-end general fund balance may it be invested in longer securities. And as we mentioned, as Carl pointed out, we would only do that if we felt that the return over the life of that security would exceed STIP. And so the graph on slide 4 is showing you the difference between a 3-year Treasury yield and the STIP yield. And so what you can derive from that is there are occasions where it looks good to go out and occasions where it doesn't. And so the overlying point that we would make is that we've got to be confident of where the general fund balance is going to be, and we've got to be confident that we're going to out-earn before we buy longer securities. Currently, we don't have any longer securities on. I don't have an opinion on the fund balance, but the general fund balance. But right now, we're not getting paid to buy those longer securities with higher STIP yields. So right now, and I think going forward, you should expect a very large allocation to STIP, but there will be occasions where we'll want to buy longer securities. And that is it for that. If there are no questions
on the treasurer fund?
I just have one. What do you think about the new sheriff in town here?
I think he's great. We were all hoping it was going to be. I don't know if saying our prayers were answered is too
I don't know how he turned it from him buying donuts tomorrow to me buying donuts.
I thought he was talking about me.
Either way.
So, John, a question, I wish the legislators were here. The treasurer's fund, every dollar in there belongs to somebody, correct?
Yes, sir. Either the general fund or an agency.
Correct, okay. That's when the fund balance starts to get low. A lot of times people will look at the treasurer's fund as a pool of liquidity for the state. But as we had to explain, it all belongs to somebody. Many times there's restrictions. Within particularly FWP, there's non-diversionary restrictions. So that is not just a sort of fund balance 2.0 that there's a lot of misperception about that. So just wanted to tell the people that aren't in the room that that's the case. But they'll read it in minutes.
With that, then, no other questions, we turn it over to Kirsten to introduce this.
Great, now we'll go back to the first presentation under tab 9. To introduce our short-term investment pool, I'd like to point out the obvious in that this pool is very large. It's over $3.5 billion. So last year we did over 950 transactions in excess of $23 billion. That's a good point to make to let you know that there's a lot of time and effort, not just on the fixed income team in managing this, but also our accounting staff does a lot of work, investment operations, and even risk management. So, all this money, when I first trained with John on how to trade this, the pure dollar amount of the trades was very intimidating. It, made me a little nervous, but we'll show you through this presentation that although there's a lot going on in STIP every day, we have processes in place to reach our strategic objectives efficiently. Our focus, just like in the Treasurer's Fund, is safety first, liquidity second, and income third. These strategic objectives, we want to preserve the principal, providing STIP participants with one-day liquidity while following prudent investment practices. Risk mitigation and liquidity are key and interrelated concepts in STIP. And with that, I'm going to hand it back to John to talk about the risk in STIP.
Thank you. So referring to slide 3, lots of sources of risk in STIP, but there's a unique risk, and that is that a participant might sell a share and not get $1 back, might get less than $1 back. And so over the years, you've heard that term as breaking the buck. And so that is the fundamental risk that we're guarding against and managing. That risk is made up of credit risk, liquidity risk, and interest rate risk. And in the context of STIP, credit risk is the largest risk that we manage. I refer you to slide 4. The graph there is showing you what the market would require for a risk premium, if you will, for investment grade corporate securities. That can be measured. It's measured in terms of option adjusted spread, or OAS. And so what I would point out from that graph is that can bounce around significantly, and we manage that and keep that in mind. Credit risk is a combination of security risk and market risk. Security risk is the risk that a particular security that we own either defaults and we lose money, or we are worried that it's going to, and so we sell it and recognize a loss. The couple of strategies we have for limiting that security risk is we diversify. We don't allow, for instance, one thing we don't allow is more than 3% in a particular security. And also we maintain an approved list. And so that's the key, we feel, to eliminating security risk. That's a list of names that we review regularly, and in fact, at least twice a year, we review that with another team with risk management to make sure that they are also believe that that list of securities is unlikely to fail. Going on to slide 5, market risk is the risk that, I mentioned the risk that the overall market's down and we need money and we sell at a loss. So a couple of ways that we manage that is through maturity caps. Carl already asked what those were, so I won't reiterate. We have minimum credit ratings. We have limits on sector concentrations, and the graph on slide 5 is showing you what we think a well-diversified set of assets by asset type. Liquidity risk on slide.
Are these your limits, or is that just the?
That's currently what they are, and the limits are in policy statement, but if you're curious about it.
No, I just was wondering. So the chart on page 5 is just where we are now?
Yeah, well, I should say as of December 31st.
Oh, okay.
Liquidity risk on slide 6 is the risk that we need to sell money to fund redemptions at a time when the market's down, and so we would force sales at unfavorable prices. And so a couple of things I would call out about that is that the state agencies don't have an option as to where they invest their cash. It's going to be in STIP. Absent the pension funds, they obviously can invest wherever Joe says. But local governments can pull all of their money with 1 day's notice. And so the chart on slide 6 just shows you a couple of things. It shows you the very significant and regular seasonality in local government cash flows, almost a heartbeat-like seasonality where in late May, property taxes come in, their finances go up, they invest more in STIP, and then it bleeds out until early November when again property taxes come in and it goes back up. But I would refer you to the right-hand part of that chart where you see a general increase in local government percentage of STIP. And so you might recall a couple of years ago we came to the board and asked for a change in the policy statement to increase the minimum daily and weekly liquidity, and it was in relation to that perceived risk that the local governments could take their money and that their percentage of STIP was increasing.
John, what's driving the increased STIP participation?
So, no known particular factor, but I would give you several. One is and what I feel the most likely is just the general improvement in government finances from a low point in 2015, 2016. There's been several large bond issues for schools. And so I think most of you might be from a town where there's a school being built. So after probably a long drought of that, we saw an increase. And so those bonds are issued, the amount of money is invested in STIP until sorry, go ahead.
So back to his question, so it's going to be increased property taxes and mill levy type things, is what you're saying. Is that right? Because mill levies pay for the schools generally. And then the property taxes, we've all experienced a huge increase in property taxes, so that's going to come in here, correct?
The funds from property taxes will land here, yes. The third factor will be, Kirsten will show you later that we've seen a dramatic, what we think is dramatic increase in the yield of STIP that makes it more favorable to go from maybe a non-interest bearing account at a local government into the STIP account. So those three factors I think generally account for it. Going on to slide 7, interest rate risk, which is the risk that fluctuations in interest rates will cause the value of STIP to go up or down. I would refer you to this chart, and that is just the chart of the change in the 3-month Treasury yield. So a lot of variability there, especially in times of stress. But please do pay attention to the scale there where you see that the maximum increase in the 3-month Treasury yield is maybe a little better than 0.4%. So if you were to multiply that by the duration of STIP, that's a very modest movement, but still a movement. In terms of risk, we really only worry about increases because there's an inverse relationship to the value. As interest rates go up, the value of a security goes down. Going on to slide 8, measurement of credit risk. Systemic risk is a combination of overall market risk, credit risk, and interest rate risk. So we believe that we can measure that. We have set in policy a limit on how much systemic risk we can take, and that limit is essentially, well, it is the amount of the STIP reserve. We can't take systemic risk in excess of the reserve. And so we do measure that regularly, well, always, daily. And I would just say that at the end of the year, the systemic risk was estimated, the estimated systemic risk was approximately 60% of the reserve. And so what I would like to leave you with for the risk discussion is that I think we've come a long way. I think we're contemplating, measuring, and managing the risk in STIP. If there are no questions, I'll turn it over to Kirsten.
Do we ever get from the local government questions about how we manage risk, for example? I mean, do you ever get called into local government and say, well, we're considering this, so explain this all to us, or are they just using STIP when they making those decisions on their own?
At a high level, occasionally there'll be a discussion with what's important to you, higher yield, or the possibility of a fluctuation in market value. And the clear answer has been no, we want $1 back. We want a high yield, but more important, we want to get $1 back. We don't want to generate a loss.
Okay, great. We'll turn to slide 9 here. As we've talked about a few times before, LIBOR is going away at the end of 2021. We now have a likely replacement in the secured overnight financing rate, which is SOFR. Why do you care, I guess is a good question. Why do you care about LIBOR and SOFR? Well, we buy securities that are linked to these rates. They're considered reference rates, and there's a lot of issuance linked to these. I'd like to take just a minute to give you the difference between LIBOR and SOFR. LIBOR is an unsecured wholesale interbank lending rate, which means it includes credit risk. It also has different tenors, overnight, 1 week, 1, 2, 3, 6, and 12 months. And then the methodology of LIBOR is panel bank survey submission. So you'll remember years ago the LIBOR rigging scandal. It's because this rate is not transaction based. It is based on these survey questions sent to these panel banks. So there was a pretty big decoupling from the actual market in these LIBOR rates, and people kind of played the market. A lot of banks got a lot of big fees because of this. So the banks are actually, the panel banks are also very happy not to have to submit LIBOR rate, their LIBOR submissions at the end of 2021. SOFR, on the other hand, is a market-based rate. It's all based on transactions. It's a secured overnight repo rate, meaning there's no credit risk implied in this. Currently, there's only an overnight setting on it, so you can't say, oh, what should SOFR be in 3 months, because they do not supply that. Are there any questions on the difference between LIBOR and SOFR?
When you say that the investments are linked to the LIBOR, is that a reference that is just a reporting reference, or is there actually
There's an actual
functional
yield difference?
Can you give me a little bit of how that works?
Sure. So say with LIBOR, it could be linked to a 3-month LIBOR rate, and we'll just say it's flat, LIBOR flat to 3 months. So you would be getting the yield of whatever, we'll show you on Bloomberg later, that is, and it would reset every quarter with.
So it's a determination of what rate is paid by contract or by document itself?
Yeah.
Based on LIBOR?
Yes, and then for SOFR, because it's overnight, it resets daily. So again, this is for our accounting team a little more work because every day there is essentially a new price for the security.
If I could, one of the reasons that it's taken so long to replace LIBOR and why the delay in executing it is that there are literally thousands and thousands of contracts, swaps, loans that are tied, whose interest rate floats with the old LIBOR. So the market needed a lot of advance notice as to what was going to change because there's going to be a lot of amendments to contracts and other things that are loan agreements to try to adjust to SOFR. But this is a very positive movement in terms of the integrity of the market.
And it's a positive movement in terms of the integrity market because it's market-based?
It's based that people have to actually do a transaction with real money to have an effect on it,
Right.
as opposed to a trader taking a call in London and saying, well, we kind of would charge this amount today. And so you have to vote with real money to have an effect on SOFR.
Yes.
And so is that because we're being able to track it better?
Well, you could track LIBOR too. It's just that.
I mean the transactions. You know, I mean, there's lots of transactions that go involved in the determination of the rate, I'm guessing.
Right, yeah. Like I said, it's overnight, so you can see this. There is don't want to get too into it, but there is a little bit of a liquidity issue with end of months, end of quarter, end of year. So you see a spike currently in SOFR at these times because since it's a repo rate, that's what banks need collateral for their reporting.
But the recording of the, I don't want to be, the recording of the transactions, I'm trying to visualize how that's, must be more efficient.
Yes.
In order to justify using transactions rather than anecdotal review.
Well, and less subject to manipulation.
That's the issue.
Right, I mean, that's the good part of it, but why it wasn't ever done before might have been because it couldn't have been, right?
Well, there were institutions that were surveyed that had a lot of self-interest in where LIBOR was on any given day.
I'm shocked.
Yeah. And to the extent that, not to digress too much, but in the LIBOR scandal, a lot of tape recordings of traders talking about how they could position LIBOR in any particular day came out, and so hence SOFR.
One element of the integrity is that, you know, LIBOR, as we've just mentioned, was the survey-based measure from banks. This SOFR is going to be collected by the Federal Reserve System, so and they have the capabilities to record those transactions, to report those transactions in a more efficient way. That's what I was wondering.
Great. Okay, if there are no other questions about LIBOR and SOFR, we'll go back.
One quickly, Doug, aren't a lot of the commerce programs that we participate in tied to LIBOR rates?
Not that I'm aware of.
I thought Board of Housing had a few.
They may have some, but I'm not aware of any.
Okay, so this graph on page 9 at the bottom here, the STIP net yield, our STIP performance is compared to what's essentially a 1-month T-bill index. It generally tracks fairly closely, and the yield from the securities is the biggest factor in STIP. You'll see on the left hand of the chart on the bottom, yield dropped significantly starting in 2007, and there was a long period of very low interest rates, so there was a very low yield on STIP. Finally, at the end of 2015, the Fed started raising interest rates, and you can see STIP yield climbing until the end here. You know, between 2015 and 2018, you know, 25 basis points or 0.25% to, you know, a little over 2.25. So as the private market team sometimes says, you know, 2% big whoop, but this is real money. You know, 2% of $3.5 billion is $70 million a year. That's a lot of money for the state government and the STIP participants. So, you know, percentage-wise, money-wise, there's a big difference. Are there any questions on the STIP net yield chart or the performance page here? Great. We will go to page 10 here, the STIP reserve. The level of reserving is currently set at $13,500. The STIP policy requires a target level of 1.15% of STIP assets. Because the denominator or the STIP assets are always changing, that makes this 1.15% a moving target. We got very close at the end of 2018 to reaching that target, but because of seasonal variability in STIP, now we expect to reach the target level in the next 6 to 12 months.
Is there any reason to clarify or change the policy because of that?
I do not believe so. The policy is written so that we have kind of this minimum target of 1.15%, but there isn't, I guess I would say a maximum, plus in the reserve, the interest off of the money market fund that we hold there, and we are also allowed to hold some treasuries and agency discounts. That goes back into the reserve. So as the denominator of the STIP assets is changing, that should also grow in line with it. So it's kind of once we reach that target, unless we have a write-off or a write-down, have to use it for some reason, it should be pretty steady.
Okay. And we're clear in the policy that it's a target level, not a minimum.
Correct. And so when we brought that policy before the board, we said reach it within 3 years. We will meet that. Our internal estimate was 18 months, halfway in between. The balance of STIP just grew dramatically, something in the neighborhood of $500 million from the time we brought that policy to the board, but we will still reach it within our original estimate.
Thank you. Yes.
What happened in 2015 with the reserve?
So that was a write-off, the SIV, or SIVs?
SIV or Special Investment Vehicle legacy assets.
Yeah, were written off, so we tapped into the reserve to make STIP whole.
We had some bad
stuff didn't work.
We had some bad stuff.
That dated back before 2008-9, the great financial crisis. Those were entered into in the mid-2000s, if I recall correctly.
Right.
So this was finally getting
And we were getting paid on them slowly and slowly and slowly, and finally the
And we're
staff
still
came.
getting paid on them.
Right, staff came and said we need to, essentially take these off the books by funding them with the reserve, right?
Correct.
So those assets sit in the reserve now, that we wrote them off, they're in the reserve. They're still returning money to the reserve.
Yeah, we just don't know
But we don't.
when those will finally pay off.
But to be clear, the value in the reserve is zero of those assets.
Right.
That's as we collect it, the money comes in.
Are there any other questions about the SIP reserve? Okay, if not, as John said, we're always measuring, managing, contemplating risk. After the appropriate amount of risk is determined, then we try to maximize income. And now we would like to do a short blooper presentation to show you one of our tools and processes.
Diane.
You succeeded.
I'm just protecting everyone here. All right. No.
Right. Let's see if he can log in.
3 different RSAs around.
Yeah.
A little bit, down just a little.
All right, Bloomberg is one of our tools. We use it every day, fixing continuous, always on our Bloombergs. So first thing in the morning, when I log in to Bloomberg, I run the BTMM screen, which is our treasury and money market screen. There's a lot going on here, but we'll start at the top left corner here. Here's the Fed funds rate. You would expect that to be in between where the Fed funds interest rate is of 2.25 and 2.5, which it is at 2.4. Right next to that, you can see the SOFR rate, the overnight rate. Like I said, it's easy to see this. You can track it here. We'll come down to the middle on the right here. Here's our LIBOR rates. As you can see, the different tenors here, overnight, 1 week, 1 month. So going out longer, they're higher. And also there's some credit risk implied in these longer rates as well. I'll give you an example. A couple of weeks ago, I came in and the rates were not, they didn't look like they did the day before. They were a little lower than I was expecting. And so after I came in here, I went to the WEI, or the World Equity Index, to see, well, what is going on here? Well, in that case, it looked very different than the page today with all this green. It was very red. The Dow Jones, the S&P, they were red, so there was a flight to quality, which means fixed income was more expensive, so the rates or yields were down slightly. And in this case, a couple weeks ago, the example I would give, Caterpillar had come out with their earnings and they missed slightly, and for some reason the entire market decided that was a sign that everyone was going to miss. So everything kind of fell apart. But because I did a little research to see why that was doing that, I thought, okay, that's more of a short-term issue, not something to worry about too much, especially on the fixed income side. So after I get a feeling of where the rates are, I go to our Boom screen, which is our money market offering screen. This shows you asset-backed commercial paper, corporate commercial paper, things we can buy in SIP. And in fact, we have a SIP search that is directly linked to our SIP approved list. Only things we can buy will show up in this list, which is good news.
And is that by,
we can sort anyway by.
but is it by offerer?
So dealer.
Or by the dealer? Or
Yeah, so you can sort by dealer if you would like. You can sort by security, which, we have a 3%.
Right, but my question is.
Those are only dealers that we have contracts with that we can trade with as well, yes.
Okay. And with something Amsterdam?
New Amsterdam.
New Amsterdam.
Yes.
What?
Or Narco. Yes.
Right, okay, Narco. So does that mean that we can buy anything from Narco or just limited things?
We are limited to 90 days, 90-day maturity in asset-backed commercial paper. So the DTM, those are days until maturity. So we can also sort by that. So if I said, well, I'm going to put all my money in an overnight name because I need liquidity tomorrow because we're going to pay out the state fund SIP payment to the general, or to the fire balance. So I need some money in SIP, might be the example.
That's hypothetically speaking.
Of course. And then what's really nice is the bright yellow column in the middle right there. That is the rate we're getting. So they make it very easy to find that right there. But like I said, so these are names we can buy. Let's just say, for example, that Anglesey at 2.64, well, that looks really great. I want to buy, 30 million of that, 50 million even, it's so good. We'll say, and then we can allocate it to STIP. The portfolio code is MU36 in most of our systems here, so bring up our short-term pool here. And then under actions, we can check compliance as well. Too bad I have 3% already in Anglesey, so I cannot buy that $50 million.
Tim says no.
Tim says no.
So that, and that's it? Right there, I mean, that ends it?
Yes, but let's say I forgot, or John in this instance forgot to check the compliance.
Yeah,
If we go
John's
back. It will automatically check compliance, so even if you forget and you try to submit it, it will not let you buy it. You still get that warning to pop up and, there. So another search in Boom is the government search. So these are agency discount notes and Treasury's T-bills here. You can see the rates here. The discounts here are lower because they have less risk, of course. So I typically sort this as days to maturity, as John has done, and kind of find days that I need to fill. So I look here and say, wow, that bill out to 312, that's pretty good. 2.375, if you look at the next bill on 314, it's 2.33, so a 4 basis points difference. But I think I already own some of that. So I would go to our BDS screen, which is a real-time portfolio. So if I traded this morning, this would show the trades in it already. And here I can, it's sorted by maturity automatically, and I can scroll down to 312 and see, well, do I really own that bill already? Yes, the rate was really good, and you can see I already own 50 million of it. So today I don't think I'm going to buy any more because that's a pretty good allocation, and I don't want a ton of money to drop on that one day. So I want a treasury, so we'll go to our FIT screen, which is our fixed income trading screen. And under bills, this is all the short-term bills here. You can see, and yeah, that 312 is good, but back out to kind of 4.2, or we're back out to 2.41, which is the same as 1 month later. That looks pretty good, and it kind of stays in that rate for another month or two. So 4.2, I do need some cash available that day, so we're actually going to buy $20 million of this T-bill here.
You need cash the
on that
day
4.2. We put maturities on every day so that we have liquidity every day, and this is one day that I don't have anything maturing yet.
And why, and is there, how do you remember that?
I have a book.
Okay.
I have a book, it's
Carl, this is part of the demonstration, okay? Usually we're gonna buy.
Yes, right, yes, but I have a book, that's a calendar, and we
Does the
write
machine
with-
do it, or you, so you have a book?
Yeah, a book that, John will tell you that it used to be a massive book, and now it's just a binder, and it has a calendar in it, and we write, if I buy something, I write the maturity in the calendar, and so I can look and find open spaces that I want money to fall in, and then, pension payments, outgoing, payroll, things like that, also are big in red in there, so I know I need extra money on those days.
It is interesting.
Yeah. And so we will again allocate to MA36. Yeah, right. Here we can send the order to the desk. In our case, because we have a small team, we are the desk. So our T-stocks, here is our trade management, and here we can go to the send button, and that will bring up a screen where we can choose dealers that maybe have inventory. Best practices under broker, you can see that the best rates are listed for us nicely. Best rate Usually they're very similar, if not the exact same for T-bills, especially short-term ones, because,
Wait a minute, I don't see what.
so brokers are listed over on the left, bottom here.
Oh, the
That's
other
JP
broker.
Morgan, Wells Fargo, Bank of New York, Jefferies, Goldman Sachs.
Yeah, so we,
It's in-
Oh, so he's picking them on this side and
Yeah.
that side? Okay.
yeah, and we have a limit of 5 to send this out to at a time.
You have a limit of 5.
5 broker dealers,
Bloomberg has that limit.
yes.